Hello, welcome everybody to this workshop that has been put together jointly by the New Economic School and here in virtual Moscow. I am Anna Bezhaeva, Professor of Finance of the New Economic School, and I'm very happy to see that so many of you could join us for this event. I believe that all of us are looking forward to our discussions today for several reasons. The first one is a theme of this workshop. It's very topical. As various macro issues, monetary policy, macro proof, and we're going to do it through from a special perspective. So we'll be talking about empirical work that can be done using micro level data and how this research can inform policymakers to make these complicated decisions. Is the fact that this event brought together a unique set of participants, professors from academia, from New Economic School, from Pompeu Fabra, and also policymakers from central banks, from Bank of Russia, Bank of Italy, Bank of Argentina. We look forward to our discussion. And but before, let me say a few words about the program itself. So we'll have two sessions. Each will have two papers. For each paper, we'll have 50 minutes. Each presenter will have about 30 minutes for presentation, then 10 minutes for discussion, and 10 minutes for Q&A session. So I hope it will be an interesting discussion that all of us will have. And with this, let me stop here my brief remarks, and I will give the floor to Alexander Morozov, who is the director of research and forecasting department at the Bank of Russia. Please, Alexander.
Thank you, Anna. Welcome everybody to international workshop jointly organized by the New Economic School and the Bank of Russia. And one of the benefits of the current situation is that it's getting much easier to have such events compared to events in sort of normal way when people meet face to face. So let's explore these benefits with that interesting, I very much hope so, workshop. Before we start, I would like to provide some context, applied context for the discussion we're going to have today. And a first remark I would like to say is about relationship between the monetary policy and macroprudential policy. This issue has become extremely important after 2008 global economic crisis, and there was a number of research devoted to this topic, in particular how macroprudential policy should relate to monetary policy decisions and vice versa. The topic then got additional impetus from those regulators who combine functions of monetary policy and regulator for financial sector, so-called mega regulators. As you know, or at least most of you know, the Bank of Russia is one of such regulators. So for us, a topic how we should combine, on what principles should we combine monetary policy and macroprudential policy is indeed a real issue that we have been discussing. And so far, our decision as follows. There are different approaches how this should be done. Our approach is as follows. We separate monetary policy and macroprudential policy, meaning that there are two, organizationally, there are two different organizational structures, one that deals with monetary policy and number one with macroprudential policy, and decisions are done independently. That said, of course, monetary policy decisions and discussion held is one of the ingredients when macroprudential policy is discussed, and vice versa. When we discuss monetary policy, implications of monetary policy, we have to account what's going on in terms of impact of macroprudential policy on the banking sector, other parts of the financial sector, and so on. And therefore, I may call it a kind of soft integration of monetary and macroprudential policy that we use in the case of the Bank of Russia. The link between the two policy is one of the topics that will be discussed today during the workshop. That's number one. Number two, my second remark is devoted to new methods of exploring the reality. And here we can extract benefits from so-called big data and the ability to proceed process with big data in economic analysis and including macroeconomic analysis. For many years, regulators and researchers we're dealing with so-called aggregate data. We're looking at the banking sector at large. We're looking at credit statistics, looking at macroeconomic data. Now there are ways and data sets that allow both researchers and regulators to look at so-called granular data. In the case that we'll be discussing today, it's important with respect to so-called credit registry, where information is collected on bank borrower basis. So there's data on each single credit loan provided to each by each particular bank. So it's a large data set, and indeed we have been exploring these opportunities in research and focus department and the Bank of Russia in general. Some results will be reported today, but generally speaking, this is a very prospective and interesting avenue to explore for new researchers, young researchers, because it's sort of cutting edge from research perspective, very good benefits that we may extract. We are sort of pioneers in dealing with that. So, when we try to combine both linkage between monetary policy and macroprudential policy on the one hand, and the use of granular data on the other hand, we get a completely unique mix that has never been explored and discussed before. Therefore, I expect indeed to hear very interesting results. And finally, I would like to add just a few more words about the sort of prehistory of this event. The history started pretty long time ago, about 1.5 years ago, when we knew from our colleagues from the New Economic School that Professor Jose Luis Pedro was going to come to make a presentation at the New Economic School. Then it did not work, but instead we came up with an idea to arrange a sort of broader event at that point of time in offline formats, sort of normal formats. When we got coronavirus story, and eventually, and this is how we proceed with that. It's indeed very good privilege for us to have Jose Luis Pedro speaking later today with one of his papers. He is one of the pioneers of research with the use of granular data, in particular with assessment of risk-taking behavior, the impact of policies on risk-taking behavior of commercial banks. And I'm also very much pleased that we also have representatives from the Bank of Italy and the Central Bank of Argentina among today's speakers, along with speakers from academia. So it's a very, I would say, balanced and productive mix of speakers and commentators and discussants we're going to have today. So let me wish this workshop a great success, and very much sure that we'll enjoy it. At this point, let me stop and give the floor back to Anna to proceed with the workshop.
Thank you very much. Thank you. And I suggest we just go forward and start. Hello, Jose Luis. We are looking forward to your presentation. Please, the floor is yours.
Thank you, Anna. Thank you, Alexander. Thank you for the invitation. Also, thank you for being here. I would have loved to be in Moscow today. I mean, the COVID situation, like in the city where I am right now, or I work between Barcelona and London, and both cities have problems with COVID. So it was not safe for me to travel to Russia.
So we're all in virtual Moscow now, I guess.
Okay. But hopefully in the future, I go back. I've been a couple of times in Moscow, and it's a wonderful city. So let me share my slides. So basically, I sent two papers, which are very related, to Konstantin for the discussion. I guess I will only have time to go for the first one, but the two papers are very related, and also very related to what Alexander said, which is the interactions of central bank policies. In this paper, the one that I will present is the interaction between monetary policy and macroprudential policy using European data. And in the other one is the interaction between monetary policy and supervision policy. In both cases, also related to what Alexander said, is using granular data, lots of millions of observations, more than 100 million of observations. And the nice thing about this data is you can, even for risk-taking, for financial stability, to understand the impact on the economy, you can analyze a lot of heterogeneity, which aggregate data cannot. And you can always go from the micro data to the macro data, but it's very difficult to go from the macro data to the micro, okay? So that's one of the key advantages of micro data. So the paper I'm presenting today is with two persons from the Central Bank of the European Central Bank. And one is Carlo Altavilla. Carlo Altavilla is the head in one group in monetary analysis, and Luc Leven is the Director General of Research at the European Central Bank. And of course, these are our views and not necessarily the views of the ECB or the Euro system. And let me say it's also work in progress. So a key motivation, both in the current COVID-19 crisis, but also in the, not only in the COVID-19 crisis, but also coming from the previous global financial crisis, is that this crisis show the limitation of micro regulation, and then you want to analyze risk which might impact the whole financial system. The typical risk that you see, for instance, the best predictor are credit cycles, like too soft lending standards in the boom, and maybe too tight lending standards in the crisis. So credit booms and credit crunches. And so since the crisis, there has been a more emphasis on macroprudential policy. Also with Luc and Xavier Fraser, we have a book at MIT Press analyzing prudential policy, systemic risk and crisis. So this is on the side of prudential policy. At the same time, the crisis also told us that monetary policy might be very powerful. Of course, there might be limits of monetary policy, limits especially when interest rates are very low, because it's difficult to further down the interest rates. But another thing that, and then we went to unconventional policies, and I will talk about unconventional policies later today. But one just on the introduction, just one point on the price stability, that, many times, even if you have separate organizations that analyze monetary policy and macroprudential policy, even maybe for a central bank that does monetary policy and does some kind of supervision and microprudential policy, you want to, monetary policy might affect risk-taking in the institutions, and, you might also want to have into consideration some financial stability elements. Even more when you think, and this paper is not about the global financial cycle, but if you think about the global financial cycle, when you have capital inflows and outflows, monetary policy is also having this external element to financial stability. And then there is the unconventional policies, which are affecting both the economy and to the financial sector. This is just an introduction of why macro-pru is important, why monetary policy is important. But just, for instance, in the European Central Bank, also in the Fed, I guess in the Central Bank of Russia, I'm not so sure. But during the COVID-19 crisis, central banks and government authorities, but central banks, at least on the part that they manage, for instance, in my country, Spain, the capital is mainly managed, the capital regulation is mainly managed by the ECB, the single supervisory mechanism within the ECB building, in a sense. But LTVs or DTIs are managed by the country, by the government. But in general, the central banks soften both at the same time monetary policy and macroprudential policy. So one wonders about the interaction between monetary policy, NP in the paper, and macroprudential policy, MAP in the paper. Okay, so it goes to what are the interactions. So one of the interactions is, even if you don't take into account the other issues, is that, if you tighten a lot macroprudential policy, well, if you manage well macroprudential policy, there might be financial stability in the system. And by having financial stability, price stability might be easier. Just to put an example, if you manage well financial stability, maybe you reduce the likelihood of a crisis or the severity of a crisis condition under there is a crisis. And then just because of that, you will not have price deflation. Okay, so this is an example. Therefore, since macroprudential policy affects economic conditions, it will have implications for monetary policy. Also, monetary policy, and Alexander was referring to that, might affect risk-taking. And then what should macroprudential policy do? Should you, if you are in a boom, say you are in a boom, you soften monetary policy like the US and the European Central Bank did in 2001, 2, 3, then would you like to have a macroprudential policy to try to mitigate excessive risk-taking potentially from very low interest rates in the economy? Or, for instance, do you want that the two policies reinforce each other, like in the COVID-19 crisis, in which, maybe you soften monetary policy, you give more liquidity to banks, but banks also need capital, and there is capital regulation. So maybe by softening the capital regulation, you can allow banks to pass more that liquidity from the central bank, from the expansive monetary policy, onto firms and households. Okay, so these are potential interactions between monetary policy and macroprudential policy. In that sense, they might augment the effects one versus the other. Then the other thing that I want to say is that macroprudential policy is sometimes complicated. It's complicated because, for instance, and I've been reading about the Russian financial sector. So, for instance, you might have there has been an increase on the non-banking sector. So maybe there are parts which are less regulated, and then macroprudential policy goes. It's nice because you might target the particular externality, you might target the particular risk, but there might be regulatory arbitrage. There might be, maybe the financial sector evades arbitrages part of the regulation. For instance, the creation of the US shadow banking system goes into this direction. So the nice thing about monetary policy, and Jeremy Stein used this nice expression, which monetary policy cracks everybody. So it affects everybody, and so sometimes because of the limits of effectiveness of monetary policy, there might be a role also in addition, at least on the margin, for monetary policy to potentially mitigate excessive risk, etc. Now, central banks have two views. One view is the famous, I don't have it here, but it's famous, for instance, Greenspan of, maybe there are credit booms, asset price bubbles are very difficult to identify ex ante, especially with aggregate data, not so difficult with microdata. So microdata is better to analyze ex ante whether there is an excessive credit boom. But anyway, so they are difficult to ex ante, know whether there is an excessive boom. So maybe it's easier once there is a crisis to clean up. Okay, so there is a crisis, there are credit crunches, and then you soften the policies, the monetary policy in the crisis. So this will be a passive role of monetary policy. On the other hand, if monetary policy, apart from price stability, has some financial stability objectives, it might be leaning against the wind. Meaning, on the margin, if consumer prices, so inflation on consumer prices are fine, for instance, at around 2%, but say house prices, credit spreads are either too high or too low, then monetary policy on the margin might react and then lean against the wind. Okay, so these are two views, and there are recent theoretical papers by Tobias Adrian, the head of the financial part of the IMF, Farhi and Bernin and others, talking about potential trade-off between monetary policy and macroprudential policy. So these two slides were a motivation on macro-pru and monetary policy and the interaction between the two. Now, our papers, are narrow, and so our paper has the following particular question, this particular paper, which is the interactions between monetary policy in the credit markets. I mean, many of these issues are about credit markets. Like is the best predictor, credit cycles are the best predictor of systemic risk. Many times asset price bubbles come as a consequence, or asset price bubbles without credit cycles are not so dangerous for systemic risk. So we analyze credit, and within the credit in general, the bank lending channel and the risk-taking channel. Now we're going to use, the Central Bank of Russia has, we're going to use loan-level data. And in our case, it's going to be, so there is a new European Credit Register data, and there was an initial phase. And I've been working in another paper with the Director General of Economics of the ECB for monetary policy, and in this paper more on macro with monetary policy, on the pre-European Credit Register. So the current European Credit Register, which is available to everybody, starts in 2019. So this one that we are going to use ends at that time and starts in 2012. Some characteristics which are very nice about the European Credit Register is that we have both corporate loans, consumer credit, and mortgages. We can match that with borrower and lender characteristics. We also have measures of macroprudential policy and monetary policy. The macroprudential policy, as I said before, is decided in countries, what the monetary policy is decided at the ECB. And in our particular paper, it's key to have several countries, because in a particular country there might be not so much variation of macro-pru and monetary policy, in the sense of you don't change so often macroprudential policy and so often monetary policy, so you don't have enough variation. So to have several countries, it gives you the variation. Then another thing which is interesting is one could do this with aggregate data, bank level data, for instance, but it's nice to have multiple credit registers, because going back to before, the aggregate data has some problems both on the identification of credit demand conditions, credit supply conditions, or what the banks want to do, what the borrowers want to do, or also heterogeneity. Heterogeneity is crucial for analyzing risk-taking. It's not the same thing that, for instance, a very large Russian bank takes a lot of risk than a very tiny Russian bank takes a lot of risk, right? The systemic consequences will be more important for the larger bank. Similarly, it's not the same thing that you lend to a borrower which is AAA, has high collateral, etc., that you lend with low spreads to a borrower which doesn't have much collateral, is risky, etc. Okay, so that's in that sense, credit register data allows you for that. Let me give you the preview of the results. So I may not go to all the tables, but I just want to do a long introduction so that it's clear the results of the paper. So what we find is that there are strong complementarities between the two policies. And you can read the results. In the results that we have, you can read it in two ways. So this is the main result, which is, when you have accommodative monetary policy, then there is going to be an increase in bank lending, and especially especially an increase in risk taking as well, risk taking by the less banks and to the riskier firms, and then a softening of macroprudential policy augments this. So say if you're in a crisis like the COVID-19 and you soften monetary policy, if you want to have a much impact on the economy through banks, then it's better that you also soften at the same time macroprudential policy. And sometimes when I go to the ECB and I do consulting at the ECB, the complaints of maybe you lower the capital requirements, some capital requirements at the ECB, maybe banks don't use them. But our evidence is that this softening of macroprudential policy enhances the effects of monetary policy on lending and risk taking. So this will be a more crisis perspective. If you're in a boom, maybe when you soften monetary policy, because like in 2002, like the Fed was worried with deflation, it never came to the deflation, but they were worried about deflation. So at that time, you start building up like potential bubble on real estate, both on credit and asset prices. So what we find is that in those moments of soft monetary policy, then stricter macroprudential policy will diminish the effects. Okay, so in that sense, the two are complementary, even if they are decided by different authorities, like in the case of Europe. So I was saying before, effects are stronger for less capitalized banks and for riskier borrowers. Riskier borrowers are either in terms of credit risk or in the sense of more productive firms. So basically, like in the COVID-19 type of analysis, when you soften both policies, then there will be more lending, and especially more lending to ex-ante more productive firms. Since we have household loans and corporate loans, we apply to both, and we find overall strong results for both, but the stronger results are for household loans, and within household loans for consumer loans. Okay, so this is the preview of the results. And just the final slide on the introduction is like we have, there are policies, there are papers on monetary policy. What we contribute and credit, what we contribute is to bring in the macroprudential policy. There are also papers on macroprudential policy. What we bring in this paper is the monetary policy interaction. And finally, there are papers doing both monetary and macroprudential policy, but they are theoretical. So there is a scant, limited evidence on the interactions between the two policies. Okay. So I guess I have 10 more minutes, right, Anna?
Yes.
Yes. So, like I'm not going to cover everything in 10 minutes. Let me just give you a flavor of the rest of the talk. So we have, many different countries, and then like in the credit register of Russia, we have different measures of the loan. One thing which is nice is that we have corporate and loans for many different countries. Okay, then we have credit risk variables and different borrowers' attitudes. So it's a merge of countries like the credit register of Spain and of Italy, of France, of Germany. Okay, these are mainly Euro area countries. We don't have the UK here. Well, the UK doesn't have a credit register. Then there is this macroprudential policy, which is decided at the country level. There are many different variables: capital, liquidity, LTVs, loan to values, debt to income. And then there is an ECB macroprudential database. And then since there are many measures, the way we construct the macroprudential index is to add up. So for every measure, we add up one. And then, so since these are very different measures, it's very difficult on the intensive margin to say how much of capital requirements versus LTVs. So in that sense, if you tighten LTV and you tighten capital requirements, you will add 2, etc. And so we get an index of macroprudential policy indicator for this period. Now, we are gonna, since macroprudential policy, it's related to the economic cycle, to the GDP, and to the credit booms and other potential financial variables, we take the error of this. So what is the change in macroprudential, which is not explained by current or future GDP and credit growth? There is variation across country, and even more when we take this residual here. Okay, so there are countries. Lithuania was going down, was softening. Germany was highly flat. Spain was tightening, etc. So there is variation in the data. In the monetary policy, rather than read this horrible slide, let me just tell you that rates has been very, very low, negative in the euro area. Then we did the QE, and the excess liquidity went up. There has been very different programs. Like this is the QE, the asset purchases. Then you can also buy securities from firms. You can also lend to banks. So it's very difficult to analyze all these measures. So the way, and these measures impact differently. So if you lower the policy rate, it will impact the short-term rates. If you do a lot of QE, it will impact more the long-term rate. If you lend to banks to 3 or 4 years, you will impact the medium size of the yield curve. So what we do is these different monetary policies at different times are moving the yield curve, okay, for different maturities. And then we take monetary policy surprises, meaning say half an hour before and after the announcement of the ECB, we see the reaction of the market of the interest rates to the decision of the ECB. So positive will mean that the market reacts, the market reacts. So the market thought, didn't know that the ECB was going to tighten so much policy. So the market reacts by increasing short-term interest rates. Short-term interest rates. This is the surprises for every of the different years. So of the 10 years, and then we aggregate them up. So you check how after versus before the monetary policy decision, for the different maturities, the market reacts. You add up all of them, and then positive means that the market thought that the ECB was not going to be so tightened, and then the market reacts by increasing the interest rates. And here the surprises are in the other steps. Okay, so this is the credit register data, the macroprudential policy, and the monetary policy. This is the data. As you can see, we have 100 million observations for households and 90 million observations for firms. So the average loan for a household is 20,000 euros. For a firm is 100,000 euros. So let me just explain you the basic equations. I have 4 more minutes. Basically, let me explain you one, and then I will summarize the others. So one thing that you can do is to control for many different fixed effects that might, control for the country, for the borrower, for the lender, etc. Then we do one for households, one for firms. And then we are not only interested in the impact of monetary policy and macroprudential policy, but about the interaction. So here, so let me explain you this one. So here is a minus. So here there is a minus here. So let me explain you in a different way. So suppose this is higher means tightening. Higher means tightening. So suppose that I multiply this by -1 and I multiply this by -1. Then higher means softening and higher means softening. Then this coefficient will be positive and this coefficient will be positive. Okay, so if I soften monetary policy, credit will go up. If I soften monetary policy, so I multiply by -1. If I soften monetary policy, -1 by minus this, it will be positive. So softening of macroprudential policy or softening of monetary policy will increase credit. Since these two, I multiply -1 by -1, -1 by -1 doesn't change, it's positive. So the reaction of macroprudential and monetary policy will be to enhance that. That is, a softening of macroprudential policy increases credit, a softening of monetary policy increases credit, and the two together increase this separate effect of one to another. Okay, and then you can control for different fixed effects, both in the household level data and in the firm level data. And results are relatively strong. So, if you tighten one standard deviation of both policies, lending increases 1.3%. Given the average in the period, this is high. Or if you think about just what is the impact of monetary policy on lending, you increase 42% more if you soften at the same time. Monetary policy, macroprudential policy. Effects are lower for firms, but still, this is not 42, but it's 10% larger. The lending coming from monetary policy if you increase, if you soften also macroprudential policy. Then in the rest of the paper, we analyze what is the impact of equity, both for firms and banks. And with the impact of equity, like this effect of the softening of both policies on higher lending will be higher the weaker capitalized the bank is, with a 4% increase in results. Then we take risk. This is a non-performing loan, or a non-performing loan coming from bank equity. Okay, and then for mortgages and for consumer loans and for firms. And what we find is that you will have 1.6% higher lending more if this softening of both policies are especially to riskier borrowers ex ante and by banks with less capital ex ante. Then their results are here. If we would compare these two results, which I will not tell you, but look at this number here and say this number here. So then we put this into numbers, and the effects are stronger for consumer loans than mortgages. Then finally, let me just take 2 more minutes. So finally, we also do, all this risk, and many times when we talk about risk, and especially in a central bank, on the prudential side, not so much on the monetary policy side, credit risk looks potentially negative. So let's analyze a risk which might be more positive for the economy. So we analyze ex ante productivity. And then if we analyze ex ante productivity, remember that MP and MAC was positive, meaning that they reinforce each other. And since these coefficients are positive, effects are also stronger, even more stronger for firms which are ex ante more productive in all the margins. And again, the effects are economically strong, not only statistically significant. So basically, as a conclusion, I am 1 minute late. So we are analyzing macroprudential, the interactions of these two policies, and in credit markets. And credit markets is important because many of these effects on risk-taking, on lending to the real economy because of financial frictions are through credit. It's interesting to analyze the 3 types of loans. Multiple credit register gives enough variation, and our results suggest strong complementarities. If you soften both, you will increase the credit and risk-taking in the economy. And this risk-taking is not only risk-taking by borrowers with higher credit risk, but also risk-taking in the sense of more lending to more productive firms. So thanks a lot.
Thank you very much. You're actually very disciplined speaker, so I would ask all other presenters to follow your example. Let me now invite Konstantin Yegorov, my colleague from New Economic School, professor of economics, to give his remarks on this paper, and then I will open the floor to everybody to ask questions. Please, Konstantin.
Thank you, Anna, and let me thank all the organizers for doing this event and for giving me opportunity to discuss these papers. And even though Jose Luis presented only one of the papers, I will still try to discuss both, and in the end, I will try to be very specific why I choose to discuss both. So in these papers with co-authors, Jose Luis do a Herculean task of combining and collecting all the data. And they collect data from 15 credit registers, data on bank balance sheets, data on firm balance sheets, data source on monetary policy measures, monetary policy shocks, on macro-prudential policy shocks, and I'm sure I'm missing some of the other data. And so once they combine everything, they have a unit of observation at the level of bank, borrower, and time. Actually, they have more granular data, but they aggregate this to this very fine detailed level. And then they have huge coverage, and as far as I can say, it's close to universal coverage, right? So why all this effort? What do we gain from doing a lot of work like this? So when we have more dimensions in the data, we can give more and better answers to the really big, important questions that we have to answer. So, and it's not just about having more outcomes to analyze. So we observe more things that banks do. We can say more about how they respond to the same policy. But it's also having more groups to compare. So kind of usually in estimation, we try to compare affected group with unaffected group. And the difference between the two gives us the estimation of some effect. And now, so the key of the estimation is finding these groups. And with more granular data, we can find more groups and thus to estimate the old effects that we're trying to estimate before with aggregate data, but much more accurately. And this area of research is especially important now when central banks use more tools, more policy tools, so conventional policy, unconventional policy. Many central banks are regulators, they have macro-prudential policy tools. And so it's harder and harder to find those in the economy who are completely unaffected by the tools of the central banks. And also all of these tools becomes increasingly more complex, especially after global financial crisis when the regulation increases in this complexity. So now policies and even conventional, like in developed countries, unconventional monetary policies, they also have become increasingly more complex and there are more tools. So it's harder to find those who are unaffected by the policies. And these policies, they affect more outcomes, right? So in banks, we can affect now new outcomes and this in turn affects other outcomes. And so it's harder to disentangle all the effects of monetary policy and how do they work. So in these papers, there are a lot of results. And instead of trying to cover all of them, let me just focus on those who center around the monetary policy. So first, they show that monetary policy easing, the decrease in interest rate, leads to more loans issued in the economy. So thus, they can evaluate the strength of the credit channel. And we probably can do this with aggregate data too, right? But then with aggregate data, we will have to stop here. And with more detailed data, we can go further. And specifically, we can ask, there are more loans in the economy issued by whom, right? And Jose Luis with co-authors show that weaker banks, so banks with smaller share of equity, are the ones who issue more loans. And already with this fact, we can evaluate the strength of the bank lending channel and to take it into account while deciding on our policy. We can go even further and ask who takes these new loans, right? So the loans issues to whom? And then they show that these loans go disproportionately more to risky borrowers, borrowers with bad credit history. And so already, again, we can evaluate the strength of the risk-taking channel of monetary policy. This is already kind of several times more than we could do with just aggregate data, but we can go even further. Right? So is this additional risk in the economy, is it good or is it bad? Because as policymakers, we have to, it's really important for us to know. And then they show that among all the risky borrowers, the ones who take more additional risk are the ones who are also more productive. So kind of this is good risk. And now we can evaluate the size of the excessive risk in the economy. All right, so now we see who issue new loans and who take new loans. What else can we do? Actually, quite a lot. So what next? They show who gives out which loans, right? So which banks gives out which loans. And they show that larger and weaker banks, so weaker means smaller share of equity, give loans to riskier borrowers. And now as policymakers, again, we see how, first of all, we see the distribution of risk in the economy. And we see how monetary policy affects the distribution of risk in the economy. It's very important. So all of these results are super useful for monetary policy. But the next question, and with this more detailed data, we can see kind of the inner workings of the economy, right? The more disaggregated level. But another question will be how other central banks' policy instruments affect the effects of monetary policy, and specifically all of these channels, right? And that's kind of the meat of their papers. And in one of the papers, they show that stricter bank supervision reduces risk-taking channels of monetary policy. So first of all, there are not as many new loans to risky borrowers after a decrease in nominal interest rate, but also larger banks disproportionately give out less of new loans like that, right? And then another additional policy tool is all the possible tools of a macroprudential policy toolkit. And then they show that stricter macroprudential policy reduced most of the effects of monetary policy. So again, it's not just about the overall effect of monetary policy. We can see exactly how each channel of monetary policy is affected by these other tools. And as Jose Luis emphasized, all these tools are complements. So this means that when we use more of macroprudential policy, most of the effects of traditional monetary policy becomes smaller, and so we need to use it more aggressively, right? So when we use more of one instrument, we also use more of the other. So now let me structure my comments about all the other things that we could go and deeper and look and to also make use of. So first of all, when they look at the bank supervision, so in the European Union around 2014, the rules for bank supervision become stricter in some countries for some of the banks. And they exploit this variation to show that how stricter bank supervision affects all the outcomes in the economy and monetary policy as well. But because, so there are network effects, right? Because you have data that is so rich, because you see both affected and unaffected banks, you can see more of the channels how this works. So can the bank supervision decrease the total amount of risk, or it just shifts it somewhere else, right? So banks anticipating these new rules could shift and sell their bad loans to some other banks in other countries, which are not subject to the same new regulation. Right, and because you have so rich data, you can see whether before then the effect of new policy, where did these old loans that disappeared, where they went, whether the risk was reduced or it just shifted to less regulated regions, or to put it another way, whether the bank supervision is still affected when it's not universal and when it applied only to some banks and some countries. Another issue is identification of monetary policy shocks. So Jose Luis with co-authors, they use very standard tools. It's high frequency identification. We look 15 minutes before, 15 minutes after, and we look at the surprises and we sum up them in quarter and use that. But now with such rich data, perhaps we can do more. So it will be very interesting to look at the variation within the monetary union or within countries. So we all know that different countries would like to have different nominal interest rates. When they're combined in a monetary union, they can't. They have to have the same interest rates. So for some of them, it's too high. For some of them, it's too low. So with this data, you can look more closely at the monetary union. But you don't even need to have monetary union, because different regions in the country are also in a monetary union of this country. Right, so for some regions, interest rate too low. For some regions, it's too small. It will be interesting to see how this translates to different outcomes. Now, it's not so easy to say, because how to interpret this, right? So if I'm in a country, in a different region, there is an unexpected economic shock. So because of that, the national interest rate changes. Is it the unexpected change in interest rate? So it's like monetary policy surprise for me. Or if other regions are systematically different, they get different shocks all the time. Is it kind of, for me, different parameters in Taylor rule? And is it systematic component of monetary policy? So there is more work to be done along this dimension, but I think it's all very interesting, and it will be good to see how these monetary policy shocks translate to the rest of the economy. And then the last point is that we can go further and more on productivity of firms. So Jose Luis with co-authors, they estimate productivity based on inputs and sectoral shares. It's very standard toolkit. But actually, under misallocation, some firms, there could be distortions, and some firms could have better and cheaper access to credit. And as far as I know, this will show up as these firms are more productive, right? And then kind of you will get similar results almost mechanically. So there are more loans in the economy who they're going to go to. They're going to go to firms that have better access to credit, and we will measure them as more productive, right? And you can kind of leverage your data more and take a difference in productivity across time. And this way you can eliminate the constant distortions, and then you can say that whether credit goes to firms that grow faster or not. So I'm totally out of time. So let me just conclude, and that this is very ambitious research agenda. And this is why, for me, it's not just a paper. It's not just 2 papers. It's a whole new research agenda, which is very ambitious. And it's, in my opinion, likely to become the new workhorse approach to answering all the important questions for policymakers. And if anything, it could only be strengthened if we replace our standard tools, which kind of were well developed for aggregate data and which are great for that. But now we can strengthen them even further by leveraging this more detailed aggregate data. Thank you.
Thank you very much, Konstantin. Lots of comments, lots of suggestions. Jose Luis, please answer maybe some of the most important ones, so that we have a bit more time for other questions as well.
Perfect. So many thanks, Konstantin, and many thanks for all the suggestions. And for sure, we will pursue especially these 3 on the. So first of all, many thanks for the nice comments, and then also for suggestions, and in particular the suggestions of the network effects. We can check exactly what you said, which is, if I am so in the other paper I didn't present, but if you are more supervised, then you lower the risk. But this risk is where is going the risk, and we can analyze that. In a sense, is moving from the loan level data to the firm level data, and see whether firms that were borrowing more from affected banks through supervision, at the end of the day, they are also affected because they cannot switch easily with unaffected firms. So this is definitely something that we should do. The second one, again, yes, we should do it like more on the Taylor. So we take the surprises, but the surprises is not the same thing. For instance, in 2017, Spain was in a boom, and say I don't know, but say Italy was not so in a boom. So therefore, the same monetary policy surprise has different stance of monetary policy in the different countries. And then the last one on the productivity, which is one part is one part there in each paper. So to make it, instead of taking the simple one that people have used, like Gopinath et al. In the QGA paper, to be more ambitious, get a better measure. And it's nice because there has been a lot of research on, and we know that credit and misallocation are important, and to go more deeper into that, that would be very nice. And thanks a lot. Thanks even more for sending you 2 papers, despite that I could only present one. But as you said, the 2 are very related, and that was my original idea to combine both. Thanks a lot, Konstantin.
Thank you. So let's maybe give a floor to others, opportunity to ask questions. I think Andrei, would you like to ask? I don't hear Andrei. So who else would like to ask?
I'm here.
Yes. Please.
Good afternoon to everyone. Yeah, I chatted. I posted a question. So. Dear Jose Luis, do you differentiate the effects? So, do you differentiate the macro-prudential measures, their effect on a particular kind of lending? So the direct effect of macro-pru measures that were directed to this particular kind, and some spillover effect, like in paper I posted here, an unheard corpse, toll and FX snowball. And what about softening monetary policy? How does it change this spillover?
That's a very we don't do it in this paper. For instance, on the FX, so in the euro area, most of the loans are in euros. It used to be loans in the previous crisis. Some people were doing a carry trade, borrowing in Japanese yens and in Swiss francs, mainly in Central Eastern Europe, not so much in Western Europe, but still is an interesting question. We don't do it. I have papers, I have a paper, for instance, on data in which FX are important, and then there we distinguish prudential regulations or macroprudential regulation on FX, for instance, capital controls or FX hedging policies by the central bank on supplying hedging forwards for FX, and then there is targeting this particular type of policies.
So
in the current paper, we don't do it. One thing that we could do, and we have not done it, along this line, differentiate between borrower-based macroprudential policies like LTV DTI versus bank macroprudential policies. So this is something that we could do.
Thank you very much. I thought not about so much FX lending. How about spillover effect in that paper? So so you have three kinds of lending: mortgage lending, consumer lending, and corporate lending. So we're targeting these types of lending.
Exactly. Yeah. That's very interesting. So let me just rephrase the question. So what you're saying is, so if you tighten, for instance, LTI and DTI of mortgages, then banks are gonna supply more consumer lending to those.
Yeah, exactly.
Definitely a very interesting question. We don't have it here, but it's definitely super interesting to do those things. Thank you.
Vincenzo, I could see that you raised your hand also.
Yes. Well, actually, one more question was already answered, because I was wondering, since you have both borrower-based and capital-based measure, maybe effective. But another issue, I think, is where there is tension between monetary policy and macroprudential policy is, for example, when you condition on some shock. Think about a positive productivity shock. In that case, you have an increase in output, a decrease in inflation. So therefore, you need, an expansive monetary policy. At the same time, you should have, a tightening in macroprudential policy. So in that case, this is, where it would be interesting to see if condition on this type of shock, still you find that complementarity is important. Another issue that now is very, very much important in Europe is the lower bound, because you have a lower bound for interest rate, but you had also a lower bound for countercyclical capital buffer. Actually, a lot of countries didn't have any buffers, so this was a big issue. So how do you deal with that? How are you control for this lower bound? And because in that case, you can have, for example, this is particularly important in a recession. So there is an asymmetry, I would say. So during a boom, okay, complementary is fine, because you have both expansionary monetary policy and tightening macroprudential. In a recession, you should have both expansionary monetary policy and expansionary macroprudential. But if both are a lower bound, there will be an issue. So this will be also interesting to see if there are some complementarities with other macroprudential tools. And finally, my last remark is on, will be also interesting to see the persistence. So if, for example, you have this monetary surprise, but if this monetary surprise is complemented with a macroprudential measure, this have any effect on persistence? So this could be also, I think, an interesting issue to deal with. I mean, with your data, for sure, you can do it. Thank you.
Thank you. Many thanks. The last one on the persistent, for sure. That's a very nice point. I mean, so basically, just to put it into perspective, this monetary policy surprise. So if you take the typical monetary policy, it's sticky because say you enter into a cycle in which it's the next one. So it's persistent, the monetary policy. When you take shocks, surprises, they are not persistent per se, and the effects are short-lived just because the shock is not persistent. But what Vincenzo is saying, like now, if you use macroprudential policy, since they complement, it can lead to more persistent. And this is very easy because it's just to take in T+1, T+2. So that's kind of very easy.
Yeah, impulse response, a sort of impulse response.
Exactly. Or the local projection a la Jourdain. So on the asymmetric effects, let me just say on the countercyclical capital buffer, it's true that many countries didn't use it, but there is one component on Basel, which is also, so there is this CCYB and CCB. So, they also can decrease. So the regulators also allow to decrease the conservation buffer, not only the countercyclical capital buffer. So in that sense, countercyclical capital buffer, you could use the conservation buffer. And the point of the lower, but definitely the asymmetric effects, they are super interesting. Boom versus bust, tightening versus softening. This is something that we could do. On the lower bound of monetary policy rates, that's also the way we use it, this monetary policy strategy, which is also from one of my co-authors, has a paper on the GME on this. On the difficult to do, at least in this paper, because that's expand the paper, is how dependent whether you have demand shocks versus productivity shocks, how monetary policy and macroprudential policy interact. That will be like another paper. That would not fit so much here. It's like another paper, but yeah, you're completely right. So there has been papers on, monetary policy depending on macroprudential and productivity shocks versus demand shocks, like how the two combine. There are theory on that, but, empirics are lacking, and that would be definitely super interesting. Thank you.
So we have 2 more common questions, and I suggest to actually ask them because I think it's actually a very interesting discussion. So I hope other participants will not mind. Please, Henry.
Thank you, Anna. Jose Luis, thank you. Due to Konstantin's presentation, an idea came to me. Can I dare offering 2 paths of the research extension, if you allow? So the first one, Konstantin mentioned that European regions are systematically different. It seems to me that you could easily greatly add value to your research if you switch from larger, weaker banks to just 3. You have global systemically important banks within the EU. You have domestically, or so-called in EU, other systemically important institutions. And actually, there is a sort of a matrix that you have also banks running IRB, internal ratings-based approach, that macro-pro impacts differently. So just adding 3 dummy variables at least would drastically differentiate and make it just more interesting. And can I dare making a just imaginary second proposal? That's a sort of a joint issue. If just imagine, if possible, just if you could tell whether you are interested in or not. You mentioned that you used data on 15 countries. What if you used data on 16 countries? Would you be interested in rerunning your research if it was possible?
Of course. That's for sure answer. Yes, it's like a yes, like a big yes. Of course, that would be amazing. That would be amazing. Of course, that would be amazing for this project or for another or for a different paper. That would be super interesting. So there's a possibility to work with you guys with the Russian data, the Russian credit register. That would be attractive to me for sure.
Thank you.
Thank you. So on the other one, let me just say briefly, like 10 seconds. So Konstantin was referring to the other paper, which I didn't have, unfortunately, time to go. And in that paper, we talk about global systemic banks, say Deutsche Bank, Santander, or UniCredit, and they behave very differently. And the supervision.
Or BBVA, for example.
BBVA also enters, and the supervision affects especially these global systemic risk banks differently. This is the only, and the middle size versus the lower size is not so important. It's just the super large globally systemic banks. So we did it in the other paper, not in this one that I presented today, but in the other one. So thanks, and thanks also for the second one suggestion. So
I'll be a very bad session chair, but Mikhail Mamonov to ask an important question about zombie banks. And this will be the last question, and we'll go to the next paper.
Hello to everyone. Jose Luis, thank you for amazing presentations, really encouraging a lot. I have a question about zombie lending. Like there is a growing evidence of zombie firms, zombie lending in many different economies. Like I recently read an article by The Economist, which describes new evidence, anecdotal evidence for different EU countries. So for your countries, it could be also important. For Russia, we also have this issue. And it's just interesting with this rich data at hand, the loan level data. Can you somehow develop a test for zombie lending? Can you somehow find which loans could be restructured and prolonged, and maybe in connection to firms weaker firms? And the question is about cross-country heterogeneity in this respect, because I have 15 countries. I think it could make a sense. And if we relate it to your paper, so how much could be effective the interaction of monetary when they affect jointly this problem, how much it could be effective in limiting the scope of zombie firms in the economy? Thank you.
Thank you, Mikhail. This is definitely a very interesting question. In the other paper that I did not present, but Konstantin, summarized a bit at the beginning, we have one part on not macroprudential policy, but monetary policy and super zombie lending. Zombie lending is a very difficult concept to pin down. So the way we did it is whether when there is a softening of monetary policy, you lend more to firms with current and past defaults, and whether these defaults continue in the future. And what we saw is that centralized supervision by the European Central Bank diminishes this. That is, when there is a softening of monetary policy, there is more lending to these very tricky, very risky companies, but the ECB supervision, the centralized supervision, reduces this, especially in countries like Italy and other countries. So we separate more on the JIPs versus the non-JIPs, say Spain, Italy versus say Germany, and we find effects. But this is definitely a question that is narrow in our paper, but it's a question in itself super interesting, and also the policy. Thank you. Thanks a lot to everybody.
Thank you very much. So now we cannot wait any longer, and we should move on to the next presentation by Andrei Sinikov from Bank of Russia, who will talk about somewhat similar issues from the perspective of Bank of Russia. Please, Andrei.
Yes, Anna, thank you. Do you see my screen?
Yes, we see your slides.
Okay. So how much time do I have?
You have like 27 minutes.
Okay. Excellent. So thank you very much. Thank you, the organizers, for this great opportunity for us to present our research at this workshop. So I will talk about measuring the risk-taking of Russian banks using micro-level data, and actually, as Alexander Morozov said, it's credit registry data. So it's data that started, Bank of Russia started collecting in full in 2017. It's every month, each corporate issues reports to the each bank reports to the central bank on every loan it issued during the month, and so it's also large data. I will show that. So this is work in progress, and we only at the beginning, and our team consists of Anna Burova, Genrik Penikas, Alexey Ponomarenko, Svetlana Popova, me, and Yulia Ushakova. So the standard disclaimer applies. The views expressed in this presentation are only of the authors and not represent the official position of the Bank of Russia. So outline is the following. I will show several pictures that and tell several words on motivation. Then I will represent at the beginning our contribution, then identifying strategy for this measure of risk-taking, shortly describe data, and Anna Burova, who will also present a paper today, will tell more about this data. So I will tell in that volume that is necessary for my presentation. So then I will describe empirical findings, and will, if that I will have time, I will switch to comparing this measure of risk-taking, the subjective measure of risk-taking, to ex-ante probability of default that we also can compute using this credit registry data every month and every quarter, and then I conclude. So actually, Professor Pedro drew an excellent picture on how risk-taking is important for central banks. And the general definition of risk-taking is that it's a credit risk that a lender takes on her balance sheet when issuing a loan. And there is several approaches to measuring risk-taking. So there is ex-ante measures that risk-taking measured at time of loan issuance, and ex-post measures when we can measure risk-taking after the risk is realized. So in literature, there are several simple measures of ex-ante risk-taking reported by lenders. So risk-taking also might be calculated and measured by some outsiders, rating agencies, regulator, and these measures are usually, so these measures are reported by lenders. This is credit quality groups. When a bank, a credit officer assigns some rating to a loan that bank issued, surveys of bank lending standards, and the credit and spread in credit interest rates. And we will focus on the last measure, as it is probably the most cited among the three. So that's two pictures. So as I show, our data start in 2017. So the pictures also will start since 2017. And so here's the 4 lines. 2 lines are very simple. This is a key rate, is a Bank of Russia policy rate, and 10 years government bond yield in Russian, in rubles. So, and there are 2 also lines. This is benchmark rate, is a dotted line. And this is benchmark rate is actually very simple thing. We just pick up a lender that attracted money from a particular bank during all 14 quarters and just draw this line for this particular lender. So I cannot name because it's confidential data, but this is some loans, short-term loans to this borrower by some particular bank. And the blue line, actually, what the most interesting thing is the median interest rate that we calculated using credit registry data. So we have for each quarter, we have a set of loans issued to corporates by all Russian banks, and we can we observe the interest rates, and we can easily construct the distribution and compute the median. What we see is that if you calculate the spread as a difference of blue line and other lines, we see that actually the spread is quite high. It's almost twice high as benchmark rates, whatever benchmark we take. So that means that it is important for banks. Also, if you try to analyze the dynamics of the spread as a difference, we can see that the spread declined in 2018. And what is very important is that there might be many factors that influence the spread. That might be macroeconomic factors. So bank might thought that probably macroeconomic conditions improved and started charging lower spread. There might be some effect of borrowers. So banks might started choosing borrowers with high quality, and as a result, charging lower spread to them. And we might see this in the data. There also might be effect that lower spread might mean that banks switch from uncollateralized lending to collateralized lending. There might be some other changes in loan terms. And finally, there might be some bank-specific factors, and we would like to measure those factors. So, if you take not only on the spread, this is on this picture you see actually the difference. The median is a blue line and the dotted line, benchmark rate. It's median and percentiles, 50 and 80%. So we see that the spread is highly volatile. So if we look at the data, then the spread is interest rate spread is very volatile, and we would like to understand better this heterogeneity of the spread. So this cross-sectional variation is huge. So several facts about Russian banking sector. So as we it's our banking sector is a bit paradoxical. So on the one hand, it's characterized by high concentration, and on the other hand, it's quite heterogeneous. So we have quite a large number of banks. At the same time, it's top five banks count for a major share of deposits and credit. We also have representation of state-owned and private banks. Here's some picture that shows its groups. So there is a heterogeneity and there are well-defined groups. So we would like to identify and measure risk taken and compare this risk taken across these groups. So okay, so this is just a summary of what we would like to do. So we would like to identify bank-specific component on the spread, and these factors that drive the spread I represented here. And we will follow a paper by ECB, Horny et al., and suggest identification strategy of the paper Quadri and me, and published in IR in 2008. So our second motivating factor is that we would like to fill the gap. So if we look at the studies on Russian banking sector, we can mention then there is almost no research that would try to measure ex-ante risk taking. So risk taking at the time of issuance. So most papers use ex-post measures of risk, some balance sheet variables, Z-score, NPLs. Also, there is a paper by Mikhail Mamonov that tries to measure ex-ante risk taking, but due to lack of data, authors couldn't control for borrowers variation. So the demand side factors, which we would like to fill. So our contribution, we estimate time and bank specific component of the spread for Russian banks. And we compare this, identify bank specific component, which we define as a risk taking or risk perception in groups of banks. And also we study how this subjective measure of risk taking relates to some objective measure of risk taking measured by ex-ante probability of default, which we also can calculate on this granular data. just using some PD model, and we could assign a probability of default to each loan, to each portfolio, to each bank, so we can compare and those two things. So our identification strategy is the following. So this is our definition of lenders' relative risk perception of risk taking. So imagine an experiment that so we observe two banks that we would like that we ask to price in a loan to the same borrower with same loan terms during the same period of time. So and if just looking at how banks differently priced that loan, we can infer their risk perception, the risk attitude. So this is just an illustration. So imagine that we have a data, and this data characterize a firm that borrowed from several banks. So we have a borrower, but the borrower is the same. There are 3 banks in this example, and the period when firm borrowed is the same, some particular month, and the loan terms are the same, maturity, collateral, etc. And so if we observe some variation in the spread, so among the banks, so the only reason why it might happen is due to this bank-specific component, because banks operate in the same macroeconomic conditions, so macroeconomic price of risk should be the same. The loan-specific factors also the same, as well as firm-specific factors. The borrower is the same. So if you observe the spread, there's a difference in the spread. So we can conclude that it may be only that banks different their risk perception and risk taking. So in this particular example, just illustrative example, we see that bank number 3 charges lower interest rates, lower spread, and that means that it is more risk takes more risk on its balance sheet relative to other banks. So this is the main idea, and this idea is not new actually, as I mentioned. So we collect the credit register data on all new loans denominated in domestic currency from generally for 3 years, and we restricted the sample to borrowers with multiple bank relationships in particular quarter, and run the following regression. So it's dummy regressions actually for a triple. So we had a set of dummies just to the set of fixed effects, just to differentiate this account for this variation, different variation, and the coefficient of variable of interest for us is coefficient beta 3. So it's time varying risk perception. So we run the regression for each quarter as the data is large, and we couldn't run the pooled regression. So we run the regression for each quarter, and then collected these betas for each bank. So we then grouped these betas into some groups, well-defined groups. It's the last point. So a few words about the data. So credit register data, it's the data contains borrower's ID, so we can match the data with borrower's info, their financial statements from other databases, loan terms, a lot of loan terms, interest rate, maturity, currency, whether loan new, it's refinancing of old loans, etc. And lender ID, so bank IDs, and we match the data with bank's information, their bank reports. So in total, we have 7.3 million strings. This strings is a firm X borrow from bank Y with loan term Z in quarter Q. So these strings, and we choose only 1.4 million observations of these borrowers, multiple bank relationships. You can see this in the table. So this is strings firm X borrow from bank Y with loan term Z in quarter Q, where firm X also borrow from some other banks with some loan terms in this particular quarter. And if you look how many banks participated or issued loans to such borrowers with multiple banks relationship, we will see that almost 50% of banks represent in the sample. That they issued loans during the all 14 quarters that we consider. So now we return to our empirical findings. So we calculated this beta 3. We ran the regression, calculated beta 3 for each bank, so which actually this bank-specific component, beta 3. And then we group these betas, these banks into groups, calculated and can calculate the variation of betas inside this group. So the first group is state-owned banks versus private banks. Yeah, what we see is that state-owned banks charged lower interest rate spread during almost the whole period of time. That means that they took more risk than private banks. So next picture, next group is banks with foreign capital and other domestic banks. And here's a picture also the same. We see that the level of risk perception of foreign banks is lower, which means they are to take more risk. And we see that the difference in 2020 when domestic banks reduced risk taking, but foreign banks were increasing it, have been increasing it. The last group is top 30 banks. Again, we see that top 30 banks consistently during the whole period of time price loans cheaper, so they take more risk relative to other banks. This is the picture. So we just picked the medians from other graphs or diagrams above, and here are these medians. So what we see here, and quite interesting, is that in 2018, banks with foreign capital became, by the end of the year 2018, banks with foreign capital became less ready to take risk. And if you remember, this period of time, the second half of 2018 was characterized by increasing global volatility and uncertainty related to country-specific factors, some geopolitical concerns. So, so it's quite interesting observation. And another interesting observation is that median risk perception, median risk taking actually decreased during this period in 2020 during the COVID period. But the same we cannot say about the largest banks, state-owned banks. So actually they were increasing their risk taking. So the bank-specific component of spread was declining during this period of time. So this is just summary of the results that I represent earlier. So now let me switch to comparing this measure of risk perceptions that we identified to ex-ante probability of default that we calculated. So we have this risk-taking measure. It's a bank-specific measure, and the thing that it's in some sense quite subjective measure. And we can also compute some objective measure of risk. So if you take a PD model, and actually we have such a model, so we just collected data from credit history bureaus, matched those data with company characteristics, and built a standard risk calc Moody's PD model that that could be applied So the only thing we need to run the model is to know some financial variables from financial reports, liquidity, sales growth, return on assets, EBIT, etc. Some other, and the outcome of the model is probability of default, overdue of payment in horizon starting 1 year from when the loan was issued. So I have some backup slides on this methodology later. Probably I can show them later. But so the only thing I would like to note now is that we have some PD model, so it's quite good. We checked it, and it's so our goal was not to horse race PD models. So we just wanted to do the following exercise, and the exercise is the following. So we imagine that we live in third quarter of 2019, and we can observe that Bank A issued loans to 3 borrowers. Using PD model and observing these borrowers' financial statements for previous year 2018, we can forecast defaults of these borrowers in third quarter 2020. So we can assign to each borrower its PD. So we do this, and then collect, aggregate these borrowers to portfolio and assign PD to a bank, so bank-specific portfolio PD. What we see here is that when we do perform such exercise, we cannot account for actual macroeconomic conditions that exist in third quarter of 2019, because we use lagged data, past information on financial variables, on past performance of firms. So, but for our goals, this is not important. And the reason is that we would like to compare PDs across the banks, as well as we excluded or controlled for macroeconomic variation when we identified bank-specific risk perception measure. We also don't account in macroeconomic variation when we can compute PDs. So we compute PD for each quarter, bank portfolio PD. We have for each bank we can assign a PD in each quarter. Then we can compute the median of this PD. So the blue line and the shaded area is this identified bank-specific component in the credit spreads that I described earlier. So we identified it earlier, and then black line with its borders is on the right axis is this PDs, and what we see median PD. And if what we see is that during 2018 and 2019, banks were perceiving less risks. So banks were taking more risks if we judge by risk-taking measure. But during the very same period of time, we see that median PD increased, and that means that probably when 2019 started, banks thought that somehow they perceived less risks. But if you look at PDs increased. So risks incorporated into new loans actually increased during this period of time. And this is also the PDs variation in groups of banks. And we see that there is no large variation. The differences is very small between the groups. So it's almost the same number. The only difference that catches an eye is that for banks with foreign capital and other domestic banks. We see that for banks with foreign capital, this cloud lies a bit lower than for domestic banks. That means that banks with foreign capital, branches of non-resident banks during this period of time, in average, issued loans with lower PD. So they issued loans with lower PD. So this is just an interesting observation. And here we see that there is no.
Please try to conclude so that we have.
Yeah, yeah, I'm concluding. So, okay. So we identified bank-specific components of the spread, and it can be used for further research. So we can provide new insights for prudential, try to provide new insights for prudential policy calibration. So if we observe that largest banks perceive less risks compared to smaller banks, it's a question for regulator, is it good or not? Also, we can evaluate effectiveness of macroprudential policy in Russia and test strengths of policy transmission channels in Russia along the lines of well-known paper Jimenez et al. So we have quite, we are only at the start of the road and have quite ambitious research program. So thank you very much.
Thank you very much. It's quite a cool tool that you are developing. Please, José Luis, could you make your comments?
Yes.
For the next 10 minutes. Andrei, you have to stop sharing your screen.
Yeah. I try to do this. Yeah.
Now you can see it, right?
Yeah.
Yeah.
Okay. So many thanks for allowing me to discuss this paper. It's very interesting, and as the last slide was saying, is also falls into a very interesting research agenda on monetary policy and macroprudential policy. Specifically, this paper has two parts. Is to analyze the bank, like the loan spread can be a measure of the risk appetite of the banks as compared to other measures used in the literature. So one part of the paper is about this, about the loan spread. The other is more about the PDs and comparing the PDs with loan spreads. And then all of these things are comparing different group of banks, state-owned banks, private banks, foreign banks, larger, smaller banks. Then, the interest rate, the loan spread could be depending on the macro, so on the cycle, GDP, monetary policy, global financial cycle. It could be also depending on firm risk. Say, maybe if you are in the oil sector versus you don't have collateral, etc. Then it will matter the loan specificity. For instance, shorter loans or with collateral will be less riskier than long-term loans without collateral. And finally, there is a perception of the bank, which will be kind of over and above the borrower, the loan, and the time component. So the spread is decomposed on this macro component, on this borrower component, on this loan component, and what is left is this lender, and this will be estimated for every bank, and then grouping the banks, and then showing the results for the different banks. They use the credit register data for the last 3 years, but they use also credit bureau data from before. And then you're going to get a lender's relative risk perception, okay, which Andrei described very well in the paper. For instance, a very nice result is how the different banks have the different perceptions. For instance, do you see very different? I have a paper on state-owned banks, and state-owned banks behave, even if state-owned bank in different countries might be different. But they behave differently as compared to the median or to the larger banks, etc. Then in this part here, on the final part, which ends in Q2, but there is the COVID period, and that's also interesting to analyze how this would change during the COVID period. But this is in a sense a cycle that has been going down and potentially now is changing. Then there was, you could do this with the loan, with the yields, with the spreads, or you can do it with the PDs. In general, they are very similar on average, but then they have potentially a bit different dynamics. So this going down, this is more stable, and then changing here as compared to here. Okay, so these are the results, and Andrei summarized them very well. So some particular, so I want to make 2 points. So questions to analyze in the future, and particular specific comments for the current paper. So if I say the only thing missing here, the only thing that I would say is missing is that, you know, if you look out to this equation, there is the borrower, there is the economy, there is the loan, there is the lender, but there is not a borrower-lender relationship. And we know that banking markets, and even more for corporates and especially for small and medium enterprises, you know, they tend to be complicated balance sheets, opaque. So there is some information issues, and there is a lender that does the bank firm lending relationships. And then this could be captured by a borrower fixed effect in this equation. So you could add a borrower fixed effect in this equation here. And then the lender would be over, and this beta 3 would be over and above a borrower lender fixed effect here. This is one way, especially in a period which, you know, has been stable. So there has not been like a major crisis. Or it could be captured by an observable measure on the bank lender importance, say how much a particular borrower, so this means borrower. So borrower, so bank firm lending relationship. So the borrower here. So you know, a borrower with a bank, they have different borrower, different distance, and this might matter for the results. Okay, for instance, one thing is market power. So maybe some banks have more market. The price will be higher or lower, but this is not risk, it's just market power. Just a question to think is not so, and there are, you know, it's just more rather than a comment is a question. So if we're analyzing the same borrower at the same time, and it's borrowing from 2 different banks, and one is cheaper than the other, so why the borrower is not trying to borrow more from the cheaper bank? Then maybe there might be some credit rationing, so volumes are important as rates. This comment is a very cheap comment, meaning this is impossible to in any credit register, but not only depends on maturity and collateral, but it depends also on covenants and seniority. So different banks might have different spreads. So a low spread could not only suggest that I am taking more risk, but maybe I am senior with a lot of covenants. All the banks, all the borrowers, they all will pay to me. And then this is over and above risk perception. Related to this is the loss given default. So some banks might be better in loss given defaults than others. For instance, I don't know the case of Russia, but many state-owned banks in some countries, they have higher loss given defaults because in a sense, sometimes in a crisis, the government sometimes is nicer, and sometimes the loss given default might be different. Okay, say for a foreign bank, sometimes it's more difficult to recover. So the loss given default, which is very difficult to know, ex ante, might also be driving the lender. Another thing is like they take one subsample of, if I remember, 1.3 million observations, but there is like 8 million or something like that, which is borrowers with only one bank. And this is fine to analyze the multiple lending because then they can have the same borrower, different banks, and this is the identification in order to get the measure. But once you get the measure, you could use this measure that you got, the estimated beta lending from this equation. So once you estimate this in the subsample with multiple banks, then you could go to the subsample for firms with only one relationship and see how much over and above the borrower, loan, and macro conditions, this beta estimated in the more narrow sample explains the overall spreads in the Russian economy. There is also the loan defaults, which is interesting, and it would be so how loan rates, PDs, and other factors might affect loan defaults. And then the loan rates, different from the PDs, has two things on future defaults. One is a predictive risk element, meaning lower rates might indicate that you take more risk. But the other one is like lower rates, on the other hand, you need the borrower will need to pay less and therefore will default less. So these are specific questions and comments for the current paper. For the future, once you have these risk measures, you have the credit register, you can do many things, also related to the questions that I got in my presentation. For instance, you can get global shocks like oil shocks or FX shocks, and then analyze the risk, the lending overall, and the risk taking, and how this depends on macroprudential policy, and whether there are limits of monetary policy to which one of the two, macroprudential versus monetary policy, is more effective. Okay, so it could be global oil shocks, it could be the global financial cycle, and then which policies ameliorate better the cycle. The COVID-19 also on the results, this dip going up is interesting, and for instance, state-owned banks might be more willing, have a higher risk appetite. Your times were good. Maybe even the COVID time, there could be even more differences between the state-owned banks versus the privately owned banks and even the foreign banks. Also, other policies during the COVID period analyzed, executed in Russia, and whether those policies impact the economy through the lending. Then I know that there has been some issues in the past on liability fragility of banks, how different measures of central banks affect the fragility of the liability, and then the liability is affected, the central bank tries to minimize this, and how this impacts lending and risk-taking on the asset side. Then this is the last 3 points. This connects with my previous comment on the current paper. So Russia, as far as I know, I mean, maybe I'm wrong, but thinking Russia looks like the largest, the biggest country in the world, no? So there is a lot of distance, no? So borrower lending information asymmetries, proxy by distance, might be important. The banking system is concentrated. There are many banking systems concentrated, but sorry, I touch. So, another paper that one could do is borrower lending information asymmetries and how this impacts lending and risk-taking in general or related to policies. Then there has been a rise of non-bank intermediaries and how they interact with policy, and related to Konstantin comments on my paper, there are banks which, some of the regulations are more on the banking sector than in the non-banking sector, so how this affects the economy. And then, there has been some issues about banks and the resolution, and whether these firms switch to other banks, and what are the costs of these resolutions. Okay, so this is a more questions for the future to analyze. This is more for the particular paper that Andrei presented today. Thank you.
Andrei, please.
Thank you very much from all our team for these comments, dear Jose Luis. So thank you very much. So it's a great feedback. So just a few remarks, 5 remarks actually. So we are planning to add more loan terms, more this covenants and collateral. So this now we have only one dummy variable. We are going to expand this. So regarding actually we have a parallel work that is now is an internal analytical node, and we do such and we do this exercise there. So so it's some other papers that we have actually, and by now it's unfortunately only for internal purposes. So regarding this COVID crisis, we also have papers bank lending during the COVID crisis. And what we did there, we fixed the quality of borrowers before the COVID started. And then we analyzed which groups of banks issued loans to these borrowers. So we analyzed new loans across the quality groups of borrowers in their across the quality groups. So and we also move in that direction that you mentioned. So your point on this borrower-lender relationship and asymmetric information, yes, we are planning. Actually, we are planning with Alexei Ponomarenko, who will also talk today. We are planning in that respect, but we thought about not using this geographical variation, but we thought of using this choose lenders that take the credit for the second time or for the third time at the same bank. So when somebody new enters a bank, so for unknown person or unknown company, but once a bank issued a credit to a firm, he knows a lot about her, and this creates this asymmetric information. In that respect, banks with huge client shares, with the huge the largest Russian banks, have this informational advantage over their competitors. So thank you very much. We'll think about this geographical variation. And the last point on comparing the forecasting ability of this credit spread. So actually we have, I have a picture, let me, so do you see my presentation?
Not at this moment, you should share your screen.
Yes, sorry. So here.
Yeah, now we see it.
Yeah, sorry. So do you see this picture? So actually what we see here is F-score measure. So it's out of sample F-score measure of that calculates that is used to calculate the quality of some classifying mechanism, and we see that his ability. So we compared ability of credit spread, ability of quality groups, credit quality groups that when banks assign a credit, when banks assign a quality group to a new loan, and compared our PD model and their ability to forecast defaults, and we see that PD model usually outperforms the credit spread or quality groups. So, and that means that the credit spread probably doesn't contain much information about the credit quality. Indeed, as you said, and what is interesting, this is my last point to mention, is that yes, it is very interesting, and we thought about that, but we are in nearest future we are not going to model it. Is this some feedback effect from higher lending rate to probability of default? So thank you very much.
Thank you.
Thank you. So we're a bit behind our schedule. That's my fault completely. But any questions, maybe to Andrei? So I wonder, Andrei, if quickly, so do you see similar results for just corporate bonds, essentially, for a different type of credit?
Yeah, regarding corporate bonds, we actually, this regression that we do, this dummies, actually is just replication of ECB paper that I cited it. ECB paper, the authors conduct this similar exercise for European bonds And they also try to understand this nature of this variation, using these dummies. So they try to catch up that unfavorableness and effect in treating some countries regarding some, for example, regarding German bonds or some other countries. Yeah. So I've heard only about regarding bonds market. I've heard only about this paper.
Because you can potentially try to do something similar for the Russian market.
But for us, do you plan to do similar?
No.
Or you could,
Just as a suggestion. Let's start the second half of our workshop, and I will give the floor to Alexei Ponomarenko from Bank of Russia. He will be now in charge of taking care of time and all these other boring things. Please.
Thank you, Anna. Welcome back, everyone. So we have the next session with the next two papers. We will continue to speak about granular data, but these next two papers will be more have less estimation, but more focused on measurement, which I think is not less important topic. So I invite the first speaker, Vincenzo Cuciniello from the Bank of Italy. Vincenzo, the floor is yours.
So can you see the screen?
Yes.
Okay, perfect. Thank you very much for the invitation. So this is a joint work with Nicola Di Asio. Since we are both working at the central bank, so the usual disclaimer applies. As you can see, basically we are focusing on the determinants of the credit cycle. I think that this is an important issue. In particular, we will focus on the extensive margin. So why is important credit cycle? I think I don't need to explain to this audience, but the literature basically has shown us that bank credit flows and business cycles are strictly linked. And in particular, this is a common result, that very robust result is that credit booms in general sow the seeds for the subsequent crisis. Therefore, it's not surprising that both macroprudential authorities and academia are interested in understand what are the key drivers of these credit booms. However, little is known about the margins through which bank credit flows to households and businesses over the business cycle. For example, we can have a credit boom because basically borrower can borrow more from the pre-existing lenders. So in this case, we have an increase in intensive margin. Or we can have also a case in which borrowers basically borrow from new lenders. So in this case, we have a change in extensive margin. Or we can have both. So another important issue, why it's important to disentangle the two margins, is that we know that over the course of our relationship, the lender in general acquires some private or, so to speak, soft information about the borrowers. In other words, new borrowers are imperfect substitute for pre-existing clients. This is mostly due to the information that the lenders have on their clients vis-a-vis unknown borrowers that by definition they are unknown, so they don't have this type of information. So what we do basically in this paper, we propose a methodology to disentangle the intensive and extensive margin using loan-level data. We show that determinants of the credit expansion is basically the extensive margin. After that, we apply a flow approach in order to assess the contribution of borrowers' inflows. So these are borrowers that basically enter the market, the credit market, and borrowers' outflows. Those are borrowers that are exiting the bank credit market. We also document some facts. So first of all, we show that borrowers' inflows are procyclical. They are more volatile than borrowers' outflows. And also they explain most of the fluctuation in the net creation of the borrowers. Or in other words, they explain most of the fluctuation in the extensive margin. Finally, in the last part of the paper, we show that matchy friction that in the paper are captured by the probability of finding a new bank account for the bulk of volatility in borrowers' inflows. So these are the review results. So let's start with the data. So we use the Italian Central Credit Register data. We have 5.6 million households, 2.4 million businesses, each borrowing at least from a bank. So the period is basically 20 years. These are monthly data. We consider credit granted or drawn above 75,000 euros. So this is the old threshold that was used in Italy. But in order to guarantee, don't have some sort of structural break in the time series, we keep it. We keep the old one. So the new threshold was changed in January 2009, and now is 30,000 euros. So what we include in credit, basically we have different types of credit. We have term loans, credit lines, loan backed by account receivables, and the back loans. We also collect some information on loan application from new potential clients. What happened in Italy is that when a bank receives an application from a new potential client, in general, lodge an inquiry to the Bank of Italy in order to receive some information the risk position of this client. So we use also this type of information in our analysis. So here there are some summary statistics. So basically, these are average, the average month, let's say, credit disbursement amounts to about 900 billions for a non-financial corporation. For household is 250 billions. But what is important here, is that each non-financial corporation in general borrows on average, let's say, 970,000 euros, and in general it borrows from 3 banks. So in other words, multiple relationships is a key for businesses in Italy. Instead, if we focus on households, we see that households borrow on average 140,000 euros from a single bank. So in general, they have just one bank. And also the data that basically we are, because of this threshold of 70,000 euros, so here basically we are capturing mortgages. So this is the typical credit for households. Okay. So here I show you some picture in order to have an idea of the time series of this data, also to understand how much was important for the global financial crisis and sovereign debt crisis for the credit market in Italy. As you can see, basically before 2008, there was an upward trend in credit disbursement or credit to GDP ratio, both for households and non-financial corporation. Then the economy was hit by the Lehman collapse, and after that, at the end of 2011, there was also the Italian sovereign debt crisis. This was even much more severe for the Italian economy. In fact, we see basically for businesses there was a reduction in credit. And also there was also a lot of exit. There were thousands of firms actually that exit the market. So there were a lot of defaults, and this was just to show you that these were very big shocks for the credit market. Okay, here instead I focus on the credit risk premium, both for households and non-financial corporation, and basically here you can see that when there is a recession, basically there is a spike in credit premium. Instead, when there is a boom, basically this risk premium tend to decrease. So this is quite common results, but just to show you that this doesn't depend on the sector. So this pattern holds both for households and businesses. Okay, finally, here another picture is on the number, in this case, of borrowers. And as you can see, the pattern basically mimic the credit dynamics, and also have a picture on the number of applicants. Here, there is some seasonality in this data, but basically you can see that there is in general an upward trend during a boom, and then this tend to decrease after during a recession. Okay, so now I start with this. I'll show you how we disentangle the intensive and the extensive margin. And basically, since we are using individual data, so we can do this in two ways. So a first measure of the intensive and extensive margin hinges on the bank-borrower relationships. And this is equation 1. So basically here, the net change in credit stock, which is on the left-hand side, is equal to the net change in credit to continuing relationships, which is the first term on the right-hand side. So basically, these are relationships with a bank at time t, at time t minus 1. So it's the borrower that has the same relationship with the bank. And the difference basically here is capturing the intensive margin. Then there is the extensive margin instead, is composed by two elements. So the first one is LC, which is basically the creation of new relationship with a bank, minus LD, which is the destruction, or if you want, the severance of a relationship with a bank. So this was a relationship at time t minus 1 that doesn't exist anymore at time t. Instead, LC is a relation that exists at time t and didn't exist at time t minus 1. Okay, the difference between the two is capturing the extensive margin. However, there is another way to measure the extensive intensive margin, and is basically to collapse all the data sets to the borrower level. So in other words, in this case, we are capturing the entry in the market. So the extensive margin LC in this case is a borrower that didn't have any relationship in the credit market at time t minus 1, but now has at least one relationship. LD is the opposite. So is a borrower that had some loans at time t minus 1, but now at time t doesn't have any loans anymore. At least it is not recording in a credit register. And similarly for the intensive margin. So with these two measures in mind, basically we can basically disentangle the credit fluctuation. At the same time, we can calculate the contribution of the two margins to credit fluctuation. So by simply using OLS estimation, so we have that basically the extensive margin captures the bulk of the volatility in credit fluctuation. This is true either if we measure the extensive margin as both a bank borrower at the bank borrower level, or if you measure it at the borrower level. In fact, in the latter case, we have the 60% of the volatility in credit fluctuation is explained by the extensive margin. So for simplicity, I will focus on this measure of intensive margin based on a borrower level. So in other words, extensive margin is capturing the, repeat, the entry and the exit the credit market. So we can dig a little bit deeper on this, and basically we can write the loans to borrowers entering the market as the product of two elements. So the first one is AC, average loan per borrower, and BC, which is basically the number of borrowers. Okay, is the number of borrowers entering the market, and AC is the average amount that this guy had when he received a loan. Similarly, we can do the same exercise for loans to borrowers exiting the market, and we get that basically between 80 to 90% of the variance is explained by the number of borrowers. If we calculate the correlation between the number of borrowers and LC or LD, so in other words, the loans to borrowers entering the market or loans to borrowers exiting the market, we have basically a result of 0.98, a correlation of 0.98. So which means that basically they move 1 to 1. So in the rest of my talk, I will focus on the fluctuation in the number of borrowers, simply because of this, this relation, because the extensive margin is important, but also because the number of borrowers is important to explain the credit dynamics. So now we move to another approach, which is for those of you who are familiar with the labor market, is quite common using in the labor market, this type of approach. So basically I need three definitions. So here in the labor market, the definition is employee, unemployed, and inactive. So here is more or less the same. Instead of employee, we have a borrower. So in this case, a borrower is a household or a firm that have at least one credit relationship with a bank. Then there is an applicant. So an applicant, in this case, is a household or a firm that submit at least one loan application to a new bank, because in Italy, only new bank lodge an inquiry to the Bank of Italy, because for the client that the non-client, basically they already receive every month the risk position of their client, so they don't need to lodge new inquiry. Instead, if you receive an inquiry from a new potential borrower, in that case, is in the interest of the bank to ask for information. And as I said, basically is this guy that is submit a loan application to a new bank, but that not have the bank at the reporting date. And finally, there is this residual status, which is inactive. So are households and firms that are neither borrower nor applicants during the period, but are classified as applicants or borrowers in the previous or next 6 months. So here in the baseline definition, I take as a period for obtaining loans as 6 months. So this is a very conservative measure. I have some robustness also on that. So with these three definitions, basically we know that in each time we have three categories of three types of client in the credit market. So we have a borrower, an applicant, and inactive. After 6 months, we check if this is still a borrower. So in this case, we are here in the BB cell. Otherwise, this borrower can become an applicant, so it's BA, or it can basically exit the market. So in this case, become BE. So this is the flow. So basically, it's capturing the flow after 6 months. So in 6 months, what happened to this guy? So in other words, in equation 3, what we do is basically to rewrite the net creation of borrowers, which is delta BE, as the difference between these two flows, which is borrowers inflows and borrowers outflows. So borrowers inflows basically are applicant or inactive firms or households that after 6 months become borrower. Borrowers outflows instead are borrowers that after 6 months become applicant or inactive. So,
quick question, but you don't have those who are in default.
Sorry, don't have default.
You don't have those who are who default.
Yes, okay. Yeah, this is an issue that also we face in the paper. So basically, bad loans, those are defaults. Basically, are non-performing, but is the worst case of non-performing loans in Italy. And these guys are included in a borrower. So in our baseline definition, people that basically default, these are bad loans, they are considered borrower. So in order to change the status, they have to be to exit from the bank's balance sheet. Okay, so this is the rationale for having this definition. So this is the baseline definition. We also try to see some robustness exercise if we erase bad loans from the borrowers, but it doesn't change. Actually, it creates more volatility in borrowers' inflows. So in excessive margin is still more important in that case. But the issue is basically here that bad loans, as long as bad loans are in a bank balance sheet, is important, because this is a constraint for the bank. So this can affect also the decision to provide new loans to firms and households. that's why we take them in our definition of borrower. Thank you for, please, you can stop it every time, whenever you want, no problem. Okay, so I show you some results. So basically, these are some facts basically about these flows. So here, as I said, I mean, this is quite similar to the labor market. So here in the circle, I have the stocks. So B stands for borrowers, A for applicants, I for inactive. And then we have these arrows. So the arrows capture the gross flows. So it's households from, for example, the arrow that goes from I to B capture basically the flows of inactive guy that become borrower, and vice versa, the other arrows. So the key message here is that these gross flows are important. In fact, if we calculate at the annual level, these are a very large number. So in other words, gross flows are sizable. And also they are important both for households and non-financial corporations. So this is another results that I would like to stress here. Okay, then in that case, I calculate the average. Now I show you the time series. And here you can see one of the first main results of the paper. So basically you have that net flows, which is the solid line. Basically can be decomposed in inflows and outflows as I show you, but what is key here to capture the dynamic, so what is really affecting the dynamic of net flows are borrowers' inflows. And this is true for households and for non-financial corporations. So in other words, they simply move one-to-one. So this is where really the dynamics stems from. And in fact, what we formally do, we calculate again the OLS estimation in order to see how much of the volatility of net flow is explained by the borrowers' inflows, and it turns out that almost all the volatility is explained by borrowers' inflows. Okay, then I do another exercise. We try to see if there is some cross-correlation with the GDP, with the business cycle, for borrowers' inflows and borrowers' outflows. And striking results here is that borrowers' inflows are very procyclical. I mean, the correlation is pretty high, and they tend to lead the business cycle. So this is also important, for example, in terms of macroprudential policies, if you are interested in order to anticipate what will be the credit, because the credit is, there is more co-movement with GDP. Instead here, when we count the heads, so we count the number of borrowers that are entering the market, these tend to anticipate the cycle. Okay, so this is another results that we stress in the paper. Borrowers outflow, instead they try to lag the business cycle. And this is, I mean, quite understandable. They are both capturing different operation from the bank point of view. Borrowers inflows are new clients. Borrowers outflows in this case are also dealing with the non-performing loans. And basically, as I said, I mean, there are procedures that take more time, so they are less responsive to the business cycle, and this is a reason why they try to lag the change in GDP. Instead, borrower inflows anticipate, also because they are related to the expectation about the prospective investment, for example, of the borrower, or I mean, simply the uncertainty about the economy, etc. Then I have some results on the standard deviation of these borrowers' inflows and outflows. And here you see that borrowers' inflows are highly volatile if we compare to, for example, the GDP. The volatility of GDP is 2%. Borrowers' inflows, the volatility is 16%. Volatility of borrowers' outflows is 8%. But also what is interesting here is that there is some sort of asymmetry between the two flows. So borrowers' inflow is twice as volatile as borrowers' outflows. So a lot of movements actually stems from borrowers' inflows. Okay, now since I show you that basically borrowers' inflows are the key, let's say, variable to understand the determinants of the credit cycle. Now I try to disentangle a little bit further the mechanism through which borrowers' inflows can, for example, increase. So there are basically mechanically two ways. So one is when the inflow of borrowers increases simply because at a given acceptance rate, the number of potential borrowers in the market increase. Okay. Another mechanism is that for a given number of potential borrowers, simply the acceptance rate of the bank change. Okay, these are completely different mechanisms. For example, the Alicia and Marquez, they focus on the number of unknown borrowers, and basically they stress that there is a negative relation between the number of unknown borrowers and asymmetric information among lenders. In fact, when the number of unknown borrowers in the market increases, banks tend to lose credit standards, simply because there is less asymmetric information, so that they don't know if the guy that is asking for a new credit is basically, let's say, a lemon or not. So because basically there are unknown clients in the market, and there is a high probability that a lot of these guys basically have a good investment projects. Another mechanism stressed by the literature is, for example, the Han and others, and Basman and Bale, they emphasize the role of the matching friction between the bank and the borrower. So in this literature, basically, this friction that in this case is captured by the probability of matching with a new bank amplify the credit flows, and at the same time amplifies the business cycle. So this is a key mechanism at work. So now I try to distinguish between, I try to measure these two mechanisms by simply rewriting in equation 5, borrower's inflow as the sum of two elements. So F is basically the new bank matching probability. So this is capturing the matching friction, so to speak. So, and then there is another element, which is A plus I, which denotes the number of unknown potential borrowers in the market. So this is the Laricha-Marquez mechanism, basically. So the higher is the number of unknown borrowers in the market, the less is symmetric information between banks. Decomposing again the borrowers' inflows in these two elements, it turns out that the loan funding probability explains 70% of the volatility of borrowers' inflows. So in other words, matching frictions seems to be key in order to explain the movement in borrowers' inflows. How much time do I have? Maybe it's okay.
1 minute.
Okay. Okay, here I do some robustness. So basically, in order to filter, in the baseline, I use the annual growth rate. I use also Audrey-Prescott. Instead of GDP, I also try to see if there is correlation with unemployment rate. As I said at the beginning, I exclude also non-performing borrowers. Then I focus just on the period from 2009 and 2019, so as to have this threshold of 30,000 euros. I use also an alternative definition of borrowers and applicant. But basically, the results are there. So finally, summing up, this paper will show new evidence on the role of the extensive margin in shaping the pattern of aggregate credit dynamics. We document 3 facts. So first, cyclical fluctuation in net creation of new borrowers is mainly explained by borrowers' inflows. Those borrowers inflows, second, are procyclical, highly volatile, and tend to lead the business cycle. Finally, gross inflows of borrowers are twice as volatile as gross outflows, and their volatility is mainly accounted for by the change in the probability of finding a loan. So in other words, matching friction are important in order to understand the change in credit dynamics. Finally, last remark is on the fact that monitoring and steering inflows of new borrowers may be important for macroprudential authority because there's a way if you want to smooth the credit cycle, but it's also important for monetary policy because simply because credit cycle, business cycle are strictly intertwined, this is also a way to smooth business cycle. Okay, thank you. Thank you very much for your attention.
Thank you, Vincenzo. Now I have a few slides for discussion.
Okay.
I was actually very happy to find your paper because now we are starting a very similar project. But from the very beginning, I was looking at this question at a bit different angle. So this is what I'm going to talk about. So this is my discussion, and what this paper does, I think it does a very good thing. It produces the new estimates, new measures, new indicators, which are very interesting, and uses them to describe some stylized facts. I am personally a big proponent of this approach because I think now we have alternative data sets, we have new computational facilities, we have better hardware expertise, and I think we should use it to the full. And we should be trying to estimate as many indicators as we need for our tasks. I was really delighted to see a new type of indicators appearing. Now, in fact, we have tried to replicate it for Russia. Of course, these are preliminary estimates and probably revise them. And we only have less than 4 years of data, so not much variations here. On this panel, you can see the new loans, gross turnover. On the right panel, you can see the changes in debt, which is more informative. And well, I think you can't see a lot of variations here, but actually, Chance, I was surprised that you didn't show your chart with the extensive and intensive margin, which is in the paper, and it looks very interesting, very lively here. Unfortunately, you can't tell much. Although, if you look closer, maybe you can conclude that now the share of debt that increase due to the activity of new borrowers is lower than was in 2016.
What are you including here? Households and
no, only non-financial corporations.
Non-financial corporation.
Yes.
Okay.
Well, unfortunately, we don't have.
For household is almost everything extensive margin. Okay.
Well, yeah. Actually, so we have shorter data, and we only have them for non-financial corporations. But I think we'll be doing some similar exercises. But so instead of like discussing the technicalities, I would just wanted to outline the angle that I was looking at this before I read your paper. So basically, what you hint at, or the impression I got from reading your paper and the literature that you mentioned, is that the cycle is actually driven by new borrowers. And you can also get the impression that these are the loans that are troublemakers, that default, that come in the good phase of the credit cycle and default during the negative one. So I would actually advise to, of course, I mean, if you can do it, because you, I think, already did a great job producing these estimates. So if this is the story, I think you can show it easily by just producing the ex-post estimates of default vintages for different categories of borrowers. Also, you mentioned the acceptance rates, and you showed the like aggregate indicators. But, I thought it would be interesting to see the evolution in time. So if the acceptance rates for new borrowers was really higher in one phase of the cycle than in the other, I think that would reinforce your story. But actually, at the beginning, I was looking at these developments from a very different perspective, and I would like to share it. And it's maybe stereotypical, not necessarily for Russia, but for an emerging market. And so, this view would say that actually, when new borrowers are coming, this is good. Why this is good? Because probably they have zero debt. And lending to them represents financial deepening, increasing financial inclusion, and so on and so on. So I was a bit surprised that you didn't mention this in your paper, but of course, maybe for advanced economy, for Italy, this is not an issue. But in Russia, the first thing that would come to my mind is that if we see that new borrowers are coming, this is good. I mean, of course, you increase the debt burden on aggregate, let's say the credit to GDP level, but you will have this nonlinear effect. So when you give it to someone who zero that burden, you only increase the default marginally as compared to when the existing borrower increases the debt burden further and further. And this is what we had in mind, and we wanted to use some maybe PD model-based approach to have these macro-based estimates of the GDP at risk and equilibrium credit growth, and maybe say something about the new measures of financial inclusion, because I think the measure that is computed directly from observed microdata is superior to what is used currently in the literature. It's based on some implicit measures or surveys. So, yeah, this is what I have in mind. So, I mean, maybe you could use this just to enrich the discussion in your paper. Otherwise, I thank you for your presentation. And if there are any questions from other participants? Yes, Genrich, please. Go ahead.
Thank you. Vincenzo, may I kindly ask you one question to clarify? I don't know if you could show the presentation or not. You remember you had the slide with this decomposition of extensive and intensive for bank borrower and borrower type. It was like 80% for extensive margin for bank borrower, if I remember correctly. And it was like 60. Yes, exactly. So, you know, can you please tell me whether I correctly got your methodology? So can you imagine that at period 1, the borrows from bank 1. At period 2, it borrows from bank 2. But at period 3, it borrows once again from bank 1. So from your methodology, each time it will be a sort of extensive margin because it's a new bank. But to me, it seems that it's like a sort of quasi-intensive one because it actually gets back to the first bank where it was already. So did you consider such a back switching effect? Thank you.
Yeah. Can I answer now or wait for?
Oh, I think you can answer now.
So, well, I start from this slide simply because it's simpler. So what you said basically is that when you switch bank, so this is create a sort of bias, if you want, in extensive margin. And this is captured by this measure. So bank-borrower relationship. In fact, this is much higher than the other one. Instead, when I collapse everything at borrower level, when I switch bank, this does not affect at all this measure of borrower. Okay, this is a very conservative measure of extensive margin because here I'm capturing the borrowing entering the market. Okay, so that means that if at time t-1 it doesn't have any loans, and then at time t enter the market and receive at least one loans, in this case, this is a extensive margin. Okay, in this case, it's simply a new relationship with a bank create a change in extensive margin. And I agree with you, this is a much bigger number. When I use, what was surprising me was that this number is also large for non-financial corporation. This is surprising because at the beginning, when I wrote this paper, basically I had in mind the household sector. In that case, when you get a mortgage, in general, it's a mortgage for all your life. So every time you start a new mortgage, it's extensive margin. In fact, this is what I find in the data. So basically, 95% of the volatility in household credit stems from the extensive margin. But still, also for non-financial corporation, 50% of the volatility stems from the extensive margin, which is a very, very large number.
Thank you.
Okay. Then I have some to try to, Alex, thank you very much for your comments. So, yes, I'm still thinking about the new borrower, so the role with risks. So the problem here is that I have already a lot of results in the paper. I didn't want I have to decide to write another paper maybe on this issue, because basically here there is also another literature. Basically, I think this is what you have in mind, is try to disentangle between good and bad credit booms. So this is another way to see, because, for example, if I find that all new borrowers, I mean, are also the worst borrowers in the market, maybe, you know, could be an issue. Also, there is another feature to consider is collateral. So here I'm not considering collateral, but you can have also, I mean, this is another mechanism that maybe I have in mind, but still I don't know if to include in the paper or in another work. And yes, thank you for the suggestion for probability of finding a new bank. So this is yeah, to show that the time series maybe could be useful. Thank you. Yeah, I will definitely do it. And also for the other role of the concentration. Again, I think this is not an ambiguous result. So it's an ambiguous result. So you have to deal with the good and the bad booms. So it depends what type of new borrowers are entering the market. If these guys are very risky guys and you are not asking for collateral, maybe when you receive an aggregate shock will be you know, a very bad case for the banking system, because you increase bad loans in that case. And instead, if the new borrowers are also, you know, firms with a new project or, for example, there you are simply asking more collateral for I don't know. I mean, this is the literature on this. They find different results. So it's yeah, I agree. Maybe this is an empirical issue, but I don't know if I can deal with it in this paper. But thank you very much for all your comments.
Jose Luis, please.
Yes, thank you. So very interesting, Vincenzo. So two comments. One more on the economics. So there are theories that say it's good switching and bad switching. Like the good ones is reducing the hold-up problems. Like Raghu Rajan in the Journal of Finance and Sharp in another Journal of Finance at the beginning of the 90s, they have this reduction in hold-ups. And then you should see that on loan rates, which the Banca d'Italia has loan rates. On the bad issues, which is the La Richa Marquez papers in the Journal of Finance, which go back to a paper by Broker in Econometric at the beginning of the 90s. So there is like you're afraid that that people that come to you are rejected by others. So as far as I know, in the Banca d'Italia, you have one characteristics which in the credit register, it shows whether the borrower has been trying to borrow from other banks. And that's an important element for the extensive margin, because you might be more afraid because you see that the borrower has been trying to borrow from other banks. And I think there is a limit there about around 6 months. So maybe you can exploit something on that. Another issue on economics is, so it's kind of not welfare, but optimality. So is it, or not even optimality, is it, you know, is there too much extensive margin on the boom, or is too little on the bust? Meaning on the bust, it's very difficult to switch to other banks, and then you find this heterogeneity, but it's mainly driven by the bust because it's difficult to switch. And then the final point on prediction, like for instance, in the 2008 crisis, the recession came after Lehman, but the bank stock problems already came in mid 2007. And therefore, in 2000, you know, like you would have lead variables, not only from the credit market, but also from the stock market, from banks. So is your result on GDP, liquid and lags driven by that crisis, or in general, in other crises?
Thank you. Yeah, I mean, yeah, thank you. So I start from the last question. Yeah, no, this is quite general. So I also try to shrink the period. I see that there is this correlation. I mean, it's not simply due to the Lehman crisis. So I see there is some sort of, these borrowers inflow are sort of a leading indicator, if you want. Also, when I use unemployment rate, I see this, and there is a strict link also with the labor market. Yeah, the other comments, thank you, they are very, very good. Yeah, in terms of switching now, the role of switching. Yeah, here this is my alternative definition. So because in the baseline, basically I try not to deal with the switching, because basically this is an issue more important for firms. Here I try to have a more, you know, the idea is to capture credit to the non-financial private sector. So I have firms and households, and in that case I should just focus on firms. And still I find that and this is the difference between the two measures of extensive intensive margin, when it's measured at borrower level or bank borrower level. Basically here the difference between two, I'm capturing what you said. So is this switching. And maybe yes, I should try to see if, for example, this firm had other application before, because in Bank of Italy what we have basically is the loan application, but banks they don't receive they don't know if this guy applied to other bank before. Okay, so they simply receive the information by the potential client in the last 33 years, let's say. Okay, and yeah, but this is maybe a way to again, to see if there is a good or bad a bad boom. Yeah, I see this is still an issue. I'm still trying to work on it to see if I find an easy way to include it also in a paper. Thank you very much.
Thank you, Vincenzo. I don't think we have time for more questions. I therefore invite the next speaker, Anna Borova from the Bank of Russia.
Okay. Hello, thank you, Alexei. So let me directly proceed to my presentation. Okay, so I will present about the debt service ratio and about the measuring the debt service ratio in Russia in particular, using the micro level data approach. It means the credit registry which you have from the Bank of Russia. And so the opinions are all of the authors of the paper, and it's not represent the official Bank of Russia position. So first, the key question is how to measure the debt burden for the economy. And actually here I just want to highlight the three main measurement approaches, three main indicators, which are actually different by construction and by application. The first one is the ratio of the stock of debt and its relation to the assets. It's mainly used in academia and in academic research and in corporate finance. And the second one is the ratio of the stock of debt to income. And at macro level, it's the well-known the credit to GDP measure. And the third one, and the key focus of this paper, of this research, is the ratio of debt service cost to income. And this is actually the definition of the debt service ratio. And the methodology I will highlight further some next slides. And next, the question is why to measure debt service ratio and why it's useful, why it's important. Basically, the author of the methodology and major papers and research on the debt service ratio and its application and its usage is Matthias Drechmann from the Bank of International Settlements. And in his paper from 2012, he highlights the methodology and the usefulness of this indicator in terms of early warning indicators at the horizon of 1 year. And next point, another one important point is the negative effects, which is a higher debt service ratio has on the growth of real investments, on the capital expenditures growth for the economy. And these findings are the results of this research are presented in Drechmann and co-authors of 2017. And basically, as I mentioned before, the formula for calculation of debt service ratio is it's basically the ratio of cost of servicing the debt to income. And let me compare and highlight the main differences between those two major indicators. The credit to GDP, it's basically the ratio of the stock of debt to the aggregate income if we switch from the micro level to the macro level. And basically, what does it mean? It means that we compare the stock of debt to the flow of income. So by that means it's the stock to flow indicator. On the other hand, when we talk about the debt service ratio, we compare the cost of servicing the debt, and so we have the same denominator, but the key difference is that the debt service ratio is basically the flow-to-flow measurement. And in that sense, it's more consistent because by presenting the debt service ratio, we compare the cost flow to the income flow. And also the main 2 points which we can implement in analysis when dealing with debt service ratio is the effect of remaining maturity and the interest rate effect. For the credit to GDP measure, we cannot implement it explicitly as we do in debt service ratio. And also the next important point, it's the confidence intervals. And this graphs are actually, it comes from the official statistics from the Bank of International Settlement. And here we have on the left side graph the credit to GDP series, and for advanced economies and for the emerging markets and for Russia. And we can see here that the confidence intervals are quite wide. And for the debt service ratio on the right hand side, we see that as well for the advanced and for the emerging markets. We have for the more narrow confidence intervals, and another important point which I would like to highlight that basically the statistics from the Bank of International Settlements, it was estimated on the aggregate basis using aggregates, and but when using micro level data, we got much higher levels for the debt service ratio in Russia, and you can see it in blue. The blue dotted line represents the actually estimated level of debt service ratio using credit registry. So next, I would like to highlight some key methodological points. And as I mentioned before, Drachman and Juselius, they developed the main methodology for estimation of debt service ratio. And here, essentially, this is a relation of cost of servicing the debt to income. And well, here you can see the main inputs which is required for estimation. And basically, this is the stock of debt, the amount of debt outstanding at each estimation point. And here in this research, we use a quarterly basis. So we estimate debt service quarter. The other variables are the lending rates and the remaining maturity in quarters. And what we have done, we applied this methodology to the credit registry, the micro level data. And by micro level data, I mean that we have estimated the debt service burden for each loan issued to non-financial corporations in Russia by banks. And let me explain a little bit about the database, the micro level database, which we used during this research. And basically, as I mentioned before, we made it with quarterly frequency. And 15 quarters, starting from the first quarter of 2017, and up to the present day. And in some, it gives us the 15 quarters, and we have on average 1 million entries per quarter. So in total, the size will be like 15 millions. And the main advantages of working with micro-level data as follows. We have the actual amounts of all the debt outstanding for all loans, and also, I mean, for the stock of debt, and including the details on currency and the quality mark for each new loan issued, and the details on the initial and remaining maturity for each loans in days, and the nature of interest rates, whether it was rolled over or not. And also we have the scheduled payments of interests and the principal amounts of debt, scheduled and actual information on actual payments. So next, what we have found when applying the methodology developed by Drechman to the micro-level database. First, I should mention the main assumptions which come with this methodology. The first one, the assumption on the remaining maturity. If estimate with aggregate figures, aggregate amounts of debt, which was done in previous research by BIS or previous research by Bank of Russia back in 2015 or 2017. In this research, assumptions about maturity was 13 years and 4 years. And here in this research, we used the actual remaining maturity. So we hadn't put any like constraints, any fixed assumptions on maturity. And as I will show in the results, this like reduced assumption, it produced much higher debt service ratio levels for Russia. And why? Because we found that the distribution of remaining maturity across their maturity buckets and across types of loans is asymmetric. I mean, it's more concentrated around short-term loans. Well, and the second finding is actually very interesting from their point of view of understanding how the debt service ratio is different in the economy in different industries. And we found that it's very much heterogeneous. So we have the heterogeneity in debt redemption stance as well. It means that in different sectors of economy, the debt is paid back in different manner. I will highlight it further. So, and next, I'll show you the main results that we have. So, as I mentioned, the key finding is the asymmetric distribution of the stock of debt around the remaining maturity. If we fix the quarters until the maturity of debt, and if we assume that we have the fixed maturity, whether by initial or by some other judgmental figure, we have a distribution of this maturity, which here on graph it's a black solid line. But if we deal with a loan by loan basis, we understood, we saw that actually the actual remaining maturity, it's here, it's a blue line, and it's concentrated. It's by that I mean that the stock of debt with a shorter remaining maturity, it constitutes a major part of the stock of debt outstanding. And this finding had the direct impact on the results which we had produced. And I should explain about the exercise which we have done. First we estimated the debt service ratio, assuming that the maturity is fixed by the initial number of quarters at the time of debt issuance. By that, we try to replicate the previous research. And the figures that we got, it's quite close to the estimates which previous research showed for Russia. It's about 16% per quarter on average. And but when we used the actual remaining maturity in quarters, we got much higher figures. And here you can see that the main difference relates to the short-term debt with the remaining maturity of less than 1 year. And with this exercise, we got the figures around like 25 or 30% for debt service ratio. Well, next, a few words about the currency composition of debt service ratio in Russia. And by using micro level data, we have the information on the currency of the loans. And here you can see that the major part of debt, it comes from the ruble denominated debt. It's of domestic currency, and it's persistently the major part. Next, the second finding is in the debt redemption stance for different sectors of economy, different industries. And here, this is a log scale, so that's why you see this very neat dots at the beginning of the scale. The point is that if ideally we would like to have the situation when all the dots are placed on the 45-degree line. Here actually we can see that some dots are below, some dots are above. What does it mean? It means that some loans are repaid faster than the debt service ratio predicts. This is the interesting point for future research. And in that sense, working with micro-level database is essential, because here we can trace back all the dots to back to the loan condition, back to actually the borrower, and understand its financial conditions, the industry the borrower operates in, and relate this behavioral patterns to some economical reasoning. Well, also related to the sectoral differences is the difference in the levels of debt service ratio in different sectors. Here, just for illustrative purposes, I show 5 industries, and actually we have the estimates for all main industries in Russia under the Russian classification by industry codes. And what is interesting here, we can see that the insurance and finance accounting industry has a persistently higher debt service ratio, and actually it's increased even more in the first quarter of 2012. On the other hand, industry like construction or healthcare, they have the persistently low levels of debt service ratio, and in line with the current situation, In the first quarter of 2012, we have the high debt service ratio for the hotels, restaurants, and tourism, all that affected economy sector. Well, next, what is the main output? How we can judge whether the debt service ratio is useful in understanding the debt service burden for the economy, and whether it's enough to estimate debt service ratio using just aggregate information, or it's more useful and more feasible to come further and really implement a micro level database to estimate the debt service ratio. Here you can see that if estimated with aggregate assumptions and the initial assumption of fixed remaining maturity, we got that gray bars. When we calculated from the credit registry the actual amounts which were paid in each particular quarter, including the interest interest paid and the repayments of the main part of that, we come up with the green area. You can see here that it's higher than the estimated level of debt service ratio estimated with aggregate assumptions. And the line, the blue line, actually is the level of debt service ratio, which we have got when we relaxed this assumption of fixed remaining maturity, and when we estimated the debt service burden for each loan in the economy. Doing this, we can conclude that the debt service ratio actually it's a feasible approximation if you want to estimate the burden of servicing the debt at economy level. But it's also makes sense to use the micro level data, or at least the relaxed assumption of fixed maturity. Next, the factor analysis of the level change. Here we can see that actually the main factor due to which we have the changes in debt service ratio is the debt to GDP. But the important point is that we have different maturity buckets. I mean, by that I mean that the changes in the level of debt in relation to GDP for the short-term debt will have a much significant influence on the debt service ratio, because for the short-term debt, we only have 4 quarters for repayment at most. And for the longer term debt, like for 5 year, for 3 year, for 5 year or more, we have much longer number of quarters. And by definition, and due to the non-linearity in the methodology, in the formula, the change in the stock of debt will have a much significant influence on the debt service ratio for that estimated for the short-term part of the debt. Wow. And so next, let me proceed to the conclusion. So here the question is, what should we do? How should we understand that new levels of debt service ratio, which we estimated using micro level database? Is it high? Is it low? Is it what? And here I have this kind of placement graph, and the blue bar is the new estimated level of debt service ratio estimated with micro level database. The gray bar in the middle is the level of debt service ratio estimated with assumptions of fixed remaining maturity. Also, it corresponds to the results produced in previous research on this topic. And the black, the lowest bar, is the debt service ratio, which is available in, well, for example, in the Bank of International Settlements. And well, these colored circles, red, yellow, and green, well, it corresponds, the red level corresponds to the level of debt service ratio estimated for non-financial corporations in the developed economies. And the information about this came from the Bank of International Settlements, it's official statistics. The yellow circle, it's also for the developed economies, but for the private non-financial sector, which also includes households. And the green circle, debt service ratio for the private non-financial sector for the emerging market economies. And the information is not available actually on the debt service ratio for non-financial corporations in the emerging markets. And this is why, this is one of the reasons we cannot actually judge or make a conclusion whether the newly estimated levels of debt service ratio high or lower. We would like to have some comparable results from the emerging economies, from the countries who also have credit registries, micro level data, to compare our results, our levels of debt service ratio with other results. In that sense, it will be very interesting from the research point of view. And well, to sum up, what we found with this research by applying the well-developed methodology to the micro-level database, first, we can actually conclude that the debt service ratio is a meaningful, useful, and feasible approximation of the debt service burden at economy level. But when used with a relaxed assumption about the fixed remaining maturity. The second point is the identified heterogeneity of the debt service ratio between the different sectors in Russia. And the third takeaway, actually, the need for calibration for the international comparison of our results with other emerging market economies. And in this sense, we have the initiative with BIS, and the purpose of this is to develop research in the direction of using micro level data to make these estimates comparable with other countries. So thank you very much.
Thank you, Anna. Now I invite Horacio Aguirre from the Central Bank of Argentina.
The micro of.
Oh, sorry. Thank you. Thank you, Alexei. Thank you, Alexei, and thanks to the organizers for the opportunity to discuss Anna's papers. It's great to be back at the Bank of Russia, where very dear colleagues like Alexei work, and it's great to be for the first time at New Economic School, hopefully not the last time. And well, let me. Am I sharing the screen already? No. Not yet. Okay. There we go. Can you see it now?
It's good. Mm-hmm.
Yeah. Thank you. So let me briefly discuss what the paper does and what the main takeaways are. What are the critical aspects that I think driving the results, and what are possibilities for further work. Of course, these are my own views and not necessarily those of the Central Bank of Argentina, where I work. So this is a timely and very relevant paper. I mean, it's timely because we are all looking at financial data more and more for financial stability reasons in at least the last 10 or 15 years. So this is very timely, and this is very relevant because it uses microdata to analyze aggregate financial dynamics, which we are doing more and more. And as the paper shows, it has interesting results of its own. The paper measures debt service ratio in Russia using credit registry data for domestic banks' credit to the non-financial private sector, using remaining maturities and interest rates for quarterly data between 2017 and 19, and at the economy level for 15 aggregate industries and for 61 disaggregate industries. And what are the main findings? Well, first, that the debt service ratio is higher when using microdata than when using aggregate data. It goes from 16 to 26% of income. And what I think is critical here is consider the remaining maturity of the loans. This is what Anna shows. She also finds that higher servicing cost for higher debt servicing cost for debt with a shorter maturity. There's significant heterogeneity across sectors, and in a system in which domestic currency loans typically prevail. So I would call this the main takeaways. No, first, I'm looking at some of the critical points of the paper. What's the paper looking at? It's looking at the non-financial private sector. I understand this is businesses, but this is not explicit. I think it was explicit in the presentation. Then what about households? I don't know. We don't know if they are in this credit registry data as well, or we don't know if they are included. Of course, they are a different animal, and there are different actors with very different financial stability implications. But it may be good to know if, even if you do not look at households, if you have them in your sample or in your credit registry data, and to be explicit about that. Along those lines, I think the paper will benefit from more initial descriptive statistics. It would help interpretation of the results. Just looking at the very basic, not only at the aggregate, or I mean at the even if it's micro, the reading for DSR, but looking at its distribution. We see some of that when Anna deals with the sectoral issues, and I'm sorry, with the remaining maturity issues. But perhaps it would be very interesting to look just at DSR and see how distributed in your sample, if it's very concentrated, if it's not. And this has important financial stability implications, and it can also help us understand what's going on. So perhaps we could have a look at those statistics. Also, the paper measures DSR against national income. So I take this to be only a partially a micro level data measure, because you're actually using national income, which is fine because you're comparing against an aggregate measure of the service ratio. But when you come to think of it, if you have if you have data at the level of businesses, perhaps you could look at some business level income. In the case of perhaps in a subset of your sample, publicly listed companies, you can have revenues from the profit and loss statements, and then construct some DSR measure comparing to the actual income, not the macro level of income, but the income of the businesses which are actually in your sample. Same if it's the case with households. If you have, okay, you can look at wages or some measure of household income. And for the results, if I understand them correctly, they're basically driven by the remaining maturity. That is, what the paper shows that a micro data service ratio is similar to a macro data service ratio, as long as you incorporate the remaining maturity coming from your micro data. So I think this is good. So because this is telling you, okay, you can use aggregate data as long as you incorporate as long as you change your assumption of remaining maturity. And I think this is good because it tells you, okay, you don't, under certain conditions, you can still use your macro data. changing it accordingly. Sometimes it's use micro data, sometimes it's macro. So I think it gives you, in this particular case, the point is to change your maturity assumption and to use the actual remaining maturity data. Because in my reading, I think Anna shows a graph in which the macro level data is basically equal to the micro level one as long as you compute the remaining maturity. So this is what's doing the trick. And this is consistent with actual debt servicing as reported by banks. There are some differences, and I think Anna showed a chart which is not in the paper about the actual debt servicing and the debt service ratio, which really should be on a 45-degree line. So perhaps you could elaborate more on why the difference, and actually why it's. I guess it must be things like non-performing loans, delinquency, and so on, but I'm not sure. And actually, in 2 quarters, actual debt servicing is higher than DSR, so maybe worth looking at that. A third point is that the changes in the debt service ratio are changes in the aggregate dynamics of when the debt service ratio changes over time. This is due mainly to changes in credit to GDP. So I take this as to mean that credit to GDP is not such a bad approximation after all, at least for this period in this financial system. Which is consistent, by the way, with the fact that most debt servicing is short-term, so and less than a year. So in that case, credit to GDP might not be such a bad measure, at least when you look at the change, if my reading is correct. And there is very important in economies like Russia, in economies like Argentina, the currency denomination of the debt servicing costs, which is 85% in local currency. And Anna makes no further mention of this, but I think since she has sectoral data, it could be useful to look sectorally at this, because I mean, sectors which are more tradable activities can have higher or lower currency mismatches, and this can be very relevant in terms of financial stability. I mean, we learned this the hard way in economies like us, in which basically sometimes you have households or businesses which get indebted in foreign currency, but they have revenue in local currency, and this creates not a banking currency mismatch, but let's say an economic currency mismatch, which can be very, very risky. So perhaps it will be worth looking at whether currency denomination of debt is in which sectors, and if these sectors are more generate revenues or not in foreign exchange, foreign currency, because this could or could not be a problem in terms of financial stability. This takes me to the thing of the sectoral difference in the debt service ratio. It will also be, and here we see that the sectors that accumulate around 80% of economic value added only accumulate 50% of that and less than 50% of the debt service ratio. So apparently this could be my immediate take would be that the sector that account the most for in terms of economic activity are the least indebted, if I understand this correctly. Still, it would be useful to look at whether sectors with a higher debt service ratio are actually more risky or not. Either, I don't know, well, it's very difficult always to find the ex-ante measures of risk, but at least through an ex-post measure of risk, such as non-performing loans, and see if, and because this is important for financial stability reasons as well. I mean, there are substantial changes in the sample in debt service ratio from, I don't know, less than 50 to over 75%. So it would be useful to know if these sectors with the 75% debt service ratio are actually more or less risky. Then there is the thing of what's driving the changes in DSR, and Anna finds that lending rates play a not very significant role in the changes in DSR. And she interprets this as lending rates being translated into maturity or amount changes. So since you see that the amount changes, the amount of loans changes, since you see that maturity changes, and the interpretation is, well, this is because the price signal is translated into maturity or amounts. I don't completely see this in, or I don't completely see the evidence behind this in the paper, because it could be due to other other things as well. I don't know how much the interest rate was actually moving during that period, so as to back up this claim. So if this is important, it will be interesting to look at it a little bit more in detail. Finally, for further work, well, this is just an illustration of what I was mentioning before. You can combine, and I know this is further work, this is going to be on the paper, but you can combine, for instance, debt from data from your credit registry with balance sheet data. For publicly listed companies, you typically can do this. And actually, we did this in one of our financial stability reports. We actually combined our own credit registry database with balance sheet of publicly listed companies and computed these ratios. I don't think we computed a debt service ratio, so this would be a good exercise for us. But still, this is an illustration of the kind of thing I had in mind when I mentioned using income from your business, from the private sector that you are measuring, and not from the national accounts. Likewise, for household, you can use the credit registry data plus wage data. In our case, in our central bank, we have data of the payrolls which are paid through banks, so we can more or less reconstruct. So we can cross the which our households in the credit registry with the wage they earn, which is paid by banks through banks, and we can construct this distribution. So I think this is something also interesting to do in terms of the service ratio. We more generally, I understand you have the data, which is so you could use it, which is the bank level data, because ultimately you are interested in that service ratio for financial stability reasons. So it would be good to know what you're looking at the private sector side, and non-financial private sector side, but let's look at the banks. Let's look at those which are providing credit here, and whether credit is more or less concentrated. These changes in that service ratio are go together with higher or lower concentration. What happens in terms of sectoral distribution? Is I mean, it's just a few companies which are driving the results and which are being financed by just a few banks, or not, or this is more evenly distributed. But this is very, very important in terms of financial stability, and I understand you have this information in your data set. And to link this to the macro level data. And like I said, this is of course further work, but see, okay, you have your micro level data DSR, so let's see how it performs to growth, to some other aggregate economic indicator or financial system indicator, and relate your DSR with firm level data, with macroeconomic data, with one level data. And this can, and using this, perhaps you can see if you validate the kind of claims that Euselius and Dreman make in terms of this is a very good and a better indicator than others in terms of financial stability and early warning. Looking at this, you could also look at, since you have the granularity, you can look at the type of loans that you have and compare it with some other prices which are important, like asset prices, typically for mortgages. And this is, as we know from experience, very important for financial stability as well. So you could have a look at that. And finally, this is a more general question about the debt service ratio, and not about the paper, but the DSR, as using this methodology, considers debt, remaining maturity, the interest rate, and income. But in emerging economies, which are partially dollarized or euroized, the foreign exchange rate is very important as well, as part of your debt servicing costs, because your debt servicing costs are not neutral to a change in the foreign exchange rate. So if one thinks of further work, like I said, perhaps more general further work on DSR, when one can think of incorporating the foreign exchange rate. Well, congratulations, Anna, for this very relevant paper, and thanks for the opportunity to discuss.
Okay, so Horacio, thank you very much for very thought-provoking comments, and I think some of them we really do have in mind in our research pipeline. So this is actually the first research on the debt service ratio with micro level data. So yes, I mean, going further, now we are thinking about looking more deeply into the sectoral heterogeneity, and in particular, like you mentioned, relating the cost of servicing the debt to the financial information of particular borrowers. So relating this cost of servicing the debt to the income of a particular firm who borrows. So this is pretty much on our agenda. The same is about this currency question. Foreign currency rates, forex, this exposure to changes in exchange rates. We are also thinking about it, and probably the upcoming research, updates and more insights on debt service ratio will contain the unit on this currency exposure. The same comes to this currency details, not just in general at economy level, but for industry at industry level. Like for 15, for 61 disaggregated industry, yes, we also, maybe in next iterations, in the extension of this research, we will also have some insights about it. And the question about the descriptive statistics, yes, you're right. It would be helpful to have this in the paper, but as I mentioned, like this is the first step, so we just show like the general findings. And in the next iterations, we probably will have more like comprehensive, more enriched results on this debt services ratio, either on the economy level or on sectoral level. Well, the same comes if, like you mentioned, if we switch a little bit and have a look from the bank's point of view. Not just from the corporation, but judging from the banks, whether we have this concentration of debt service burden for particular industries, and how much actually borrowers do we have for a particular bank. Yes, I agree. This is very interesting and very useful for the financial stability implications. So in that sense, I agree. And another point is the correspondence of this debt service ratio with the financial statements of corporations, and like the graphs you showed. I think it's pretty much useful and for understanding. Actually, we do have some steps in that direction. It's not publicly available yet, like Andrei Sinikov mentioned during the first session. We have research which is internally available about this lending during the pandemic months. And in that research, we had information, financial information on particular borrowers, and we try to estimate that the burden. But this is it's just like the first steps at the beginning. It's not finished. So this inclusion of the debt service ratio as well, it would be helpful. So now we are working in that direction. Well, have I answered, or do you have some particular points which I hadn't touched yet, and which you would like to have?
Well, and actually we have more questions from other participants.
Okay.
So please, Jose.
Hi. Just two very small things. One is on the super interesting result on maturity. You can link it to theory. There are papers by Doug Diamond from Chicago in the Journal of Political Economy in 89 and in the Quarterly Journal of Economics in 91, precisely that shorter maturity might have, so there might be a selection between riskier firms and shorter maturity. So this could be explaining the results from debt service to income. Then maybe beyond your paper, the comparison between debt to income and debt service to income, going back to one question that I got in my presentation about zombie lending, there is this thing called loan evergreening, which means like whenever a borrower is risky, you want to lower the interest payments to this borrower because the borrower will not pay you, the firm will not pay you. So in this case, for the very risky borrowers, the debt service to income might be nicer, might be kind of manipulated in a sense by the bank, while the debt to income is cannot be by definition because it's the debt. So you can, even if you lower the interest rates, the loan interest rates to the risky borrower, it will show up in the debt to income. So it would be nice in another maybe application to see this debt to income versus debt service to income, how they work differently for the very, say, zombie borrowers, zombie firms versus more normal firms. These were the comments.
Okay, so thank you very much for your comment. I think it's really relevant. From that sense, I agree. We can compare how those two indicators actually work together, and whether some indicators show something that another does not. I think we can at least try to implement and show this for some more like granular comparison. So thank you very much. And also I think that comes back to that question about the maturity and whether the results at aggregate level, if this assumption about remaining maturity implemented correctly, whether the results are comparable. And yes, essentially yes, because the main point of, one of the main results of this research is if we relax that maturity assumption, what we have got from the micro level data is that essential information on the difference between fixed maturity and remaining maturity. And when we implement the new piece of information, aggregate level data, we do have different results. And this means that even if we do not have micro level, loan level information, but if we have more accurate information on the maturity structure of the debt, it will help.
Yes, perfect. I think that's a very precise point of the paper, yes.
Okay, so I think the last comment is Vincenzo.
Okay. But thank you, Anna, for your presentation. Very, very interesting. I have, just a couple of comments from a policy perspective. So since you are a macroprudential authority, what we would like to know is basically the distribution of indebtedness for households, non-financial corporation. But what really matters is for how much of these guys they are constrained. So they are financially constrained. So I think this is from a theoretical point of view. I think that debt to service ratio is a measure of financial constraint posed by indebtedness, but we don't know if this is binding or not. In other words, for example, you can have a firm which have in the balance sheet a lot of liquidity, assets that are liquid and can use in order to service their so I think that is important to know if this measure could be binding or not, and how far we are from this threshold. This, of course, is something that you can only do with microdata. To have the distribution. And another result I think is very interesting is that basically also what Jose said before. So this density of security. So if you can find, for example, okay, the first comment was about the level, so the threshold and how far we are from this threshold. The second comment is related to the remaining maturity. So in other words, if you can show that basically with different remaining maturity, you have a different probability of default. Think about, a firm that have just, 1 year remaining maturity is a firm that have to default with a debt of 10-year remaining maturity. So it's maybe a different incentive for a firm to also to default. Maybe if you can measure, this probability can be an useful information for a macroprudential authority when to decide, for example, if to apply some limits just for some maturities, given the debt to service ratio constant. Or in the other aspect, you can the first comment, you can instead choose to change the debt to service ratio. So that's it. Thank you. Thank you. Very, very, very interesting.
Okay. Thank you very much, Vincenzo. So I think it's very relevant, very interesting comments. I'll start from the second one. Yes, actually, the impact of different actual maturity or maturity assumptions on the probability of default. I think this is one piece that we could definitely implement in our, at least maybe our probability of default model, which Andrei Sinikov related to when he presented the paper on risk taking. So yeah, I think yeah, we should at least try and have a look on that in that sense. So thank you very much for noting that. And the first one about the binding constraints of debt service ratio and how far it goes. Actually, yes, in that sense, having micro level data, it's very, it's essential for doing that kind of research. And yeah, I think, yeah, at some step, if we try this, we can find some interesting findings. So in that, thank you very much for that comment.
Okay, so thanks everyone. I think we're finished almost in time.
So let me maybe make some concluding remarks. So just wanted to say thank you on behalf of everybody, for nice, interesting talks and this very interesting research. In a way, when people do look at just macro data, there is some ceiling of what can be found. So it's very important to look under the hood, essentially how the economy and banking system actually works. So I think your research agenda in general and this research of this idea of looking at micro level data is very important, and that's the future of economics and finance also to some extent. Let me also not to forget to thank, on behalf of everybody, to thank our team of assistants who helped us to run this event smoothly, efficiently, and without any technical glitches. Thanks a lot. Yeah, we have any ability to clasp here, but let me make also another announcement that I forgot to make at the very beginning. We were thinking of uploading a recording of this session online. I hope that you'll not mind. If somebody has objections, please tell this now. So if nobody has objections, and I just assume that you're okay with us putting this online, because I think it will be very useful for researchers who work on this in this area. I also hope that we will upload slides and maybe your papers also, if you don't mind, to ask separately about what can be uploaded to the website. Well, in Russia we have a proverb about pancakes that the first pancake is usually bad. But in this particular case, I think the event was actually quite nice. I hope that everybody liked it. And I hope it will be the beginning of maybe a tradition to organize this sort of specialized workshop that that should be of great interest for researchers who work on some particular area. So let's maybe think about this for the future. Hopefully, it will be just the beginning of a good tradition. What else? I think we can. Yeah,
Anna?
Alexander.
Yes, we got lucky, and we have Ksenia Yudayeva connected to us. Just she needs to be put online, and she is going to say a few words.
Yes. So
do this.
Actually, I don't think I think my camera is switched off, but I hope that you can hear me. No?
Let us try to switch on your camera. Dasha, could you please help? So
Ksenia Yudayeva, first Deputy Governor of the Central Bank of Russia.
So Ksenia, you need to turn on the camera on your computer.
At the left corner, left bottom.
Okay.
Yeah.
Yeah. Okay. Seems to be working. Miracle, technological miracle once again.
You are with us.
Yes. So, well, it was great to see you. I listened to the last minutes of the seminar, and I should say that I'm very impressed with the quality of the discussion. So actually, what I would like to do, first of all, I would like to thank all the organizers. I would like to thank the New Economic School and Anna in particular, as far as I understand that you were the main organizer on the part of the school. I would like to thank my colleagues, and of course, most of all, I would like to thank the international participants of the workshop. I think that it's very important that despite the pandemic, despite the loss of the ability to participate in person in different events, we now establish these digital ways of communications, and they work very well, and they give us opportunity to discuss jointly various research ideas, and by doing that, improve our understanding of how, as you said, in this particular case, how financial system works, how we can analyze it, how we can use it for policy, and so on. So I find it extremely important, and thank you very much for participating in this seminar. I also think that it's all the comments which I listened to were very useful for my colleague, and I think that they will try to improve their research. Based on that, on behalf of the Bank of Russia, I think that I need to say that we are very open to this kind of to organizing these kind of events. We're going to proceed with that. We're also going to have a virtual conference, policy conference at the beginning of December. So all of you are welcome to participate in this conference. And I also hope that this is the first but not the last event. And so we will be able to organize similar events in the future. So with that, let me congratulate everybody on this success, and wish all of us that we will be able to continue. And thank you. Thank you again, everybody. So that's it on my half. And I guess I can give the floor to Alexander or whoever is the organizer. Hello.
Thank you. So, so I think the official part of the meeting is over with this nice conclusion. We have the opportunity for our speakers and some guests to hang around a bit longer in this virtual coffee room. If you still have some energy and would like just to talk a little bit to each other informally, then please stay. If not, thank you everybody, and stay safe, and good night or good day, or I don't know what time of the day it is at your place. Thank you.